Good evening, ladies and gentlemen. I request everyone to settle down, please. Hello all. My name is Riya Upadhyay. On behalf of Federal Bank, it is an absolute pleasure to welcome you to our Analyst Meet 2025, a gathering where we share our journey, our progress, and the exciting road ahead. Your presence today, whether here in the room or joining us virtually, is a testament of the deep interest and confidence you have in our institution. We value this relationship immensely and look forward to an insightful and engaging session. At Federal Bank, we have always been in harmony and best of technology with the warmth of human relationships. Our guiding principles, digital at the fore, human at the core, and रिश्ता आप से है, सिर्फ ऐप से नहीं, reflect this very ethos. We are not just a financial institution, we are a trusted partner, evolving alongside our customers and stakeholders. Since we last met, we have seen steady progress, thoughtful expansion, and sustained momentum. Our footprint continues to grow, bringing us closer to our customers across key markets. Our retail and wholesale banking businesses have continued to thrive, reinforcing our position as a well-diversified, future-ready institution. Along the way, our efforts have been recognized with prestigious industry accolades. We are proud to celebrate our achievements across multiple areas. Recognized among India's top 30 future-ready workplaces, we continue to push boundaries in innovation and excellence. Our efforts in AI, machine learning, robotic automated integration have been widely recognized. We have always also been honored for our work for social good and our dedication to gender equality. These awards reflect our drive to innovate, improve, and make a meaningful impact. Let's take a moment to applaud these milestones. Our last analyst meet in 2023 was a deep dive into our business strategy, financials, and outlook. Today, we reaffirm that commitment to transparency by offering an open and candid view where we stand and what lies ahead. Given the overwhelming response to this event, while only a select group could be accommodated in this hall, we extend a warm welcome to all those joining us digitally. Every institution is shaped by its leadership, and at Federal Bank, we are privileged to have an exceptional team steering our course. Their vision, experience, and strategic clarity have been instrumental in building the bank that stands before you today. Let me introduce Mr. KVS Manian, Managing Director and CEO, Ms. Shalini Warrior, Executive Director and Head of Retail Banking, Mr. Harsh Tuggar, Executive Director and Head of Wholesale Banking, Mr. Venkatraman Venkateshwaran, Group President and Chief Financial Officer. Their expertise and insights will give you well-rounded understanding of where Federal Bank is headed. I am pleased to introduce our Chief Financial Officer, Mr. Venkatraman Venkateshwaran, who plays a key role in our financial strategy, risk management, and long-term planning. Sir.
Good evening, all of you. Firstly, let me extend a warm welcome to each one of you, and thank you, Ria, for the wonderful introduction. I'm really excited to be here amongst you, and to see the overwhelming response to this event is even more special. And I also extend a warm welcome to all of those who are joining online and watching this event. What I'll do in the next 15 minutes is take you through the macros, the economic backdrop for the first 3-4 slides, and then talk about the industry, and then how Federal has fared since the last analyst meet. When I say the last analyst meet, the point of reference, which when I come to the slide I'll mention, is going to be the one which we had in FY20, and then we had the COVID year, and 23, which Ria referred to, was a sort of interim checkpoint to see the progress. So let me move quickly to the slides. What's happening? So just a quick overview on the macro operating environment. Most of us have been hearing about the economic growth and the conditions which are prevalent today. And there are projections about what the GDP growth for the country would be in FY25 and 26. The numbers range from 7 to 6.7 for next year, and this year it's around 6.3. What we have done is we have anchored to the RBI projections for this purpose. And when we go into the next slide, I'll show you the various institutions, what projections they have given. But we should be clear, or rather we should just be mindful of the fact that yes, there are near-term headwinds. The conditions are not looking as good as it was in the past, but we are reasonably confident that this would play out and the medium-term outlook for India continues to be strong. In terms of the overall industry, the health of the banking industry is relatively much better than what it was 10 years back, both in terms of efficiency and also the capital. Banks have been preparing for the ECL transition and have been strengthening their balance sheets. We have seen some level of consolidation as well in the industry, and we believe that will continue to play out as well, both in the PS, public sector banks, and maybe in the private sector as well. Of course, the near-term threat of tariffs and what is likely to happen to certain industries, sectoral impact will play out. But having said that, there are still pockets where we see opportunities for growth, and how we capitalize on those is what we'll cover later during the session. Private banks reported a PAT growth for the 9 months at 12% YOY. This is up to December, that is Q3 of this FY. And small finance banks obviously had an impact due to the ongoing issues in the microfinance space, largely microfinance space. The declining credit growth is something which we have seen play out. And whilst for the industry, the credit growth was around 12% year on year, for Federal, our year on year credit growth was around 16%. And between sectors, there are variations. On the deposit side, whilst this number, which we're saying of 11% growth, that's at an industry level. But you have to peel it and see how is it for public sector banks and private sector banks. And there are a couple of large private sector banks who have grown their deposits faster during this 9 months, mainly because of the CD ratio issues. I'm sure you all know which are the two big banks who have had to grow the deposits faster and slow down on credit growth. Now, in this slide, you can look at from FY23 Q1 onwards, how the economic growth, GDP played out, and the trajectory of the GDP growth. And obviously, last 3 quarters, it's been coming down, which is the reason why there has been a moderation in the full year growth outlook for the country. RBI projections for FY26 is 6.7. And as you can see, various bodies have forecast from 6 to 6.8. We have, like I said, chosen to go with the RBI numbers. But what more important is the graph on the left side bottom, which is on the inflation moderating and showing signs of coming within the band which RBI wants to operate. And Of course, we all saw the first rate cut, which happened a few weeks back, and alignment towards the band which RBI is expecting to land the inflation numbers. Banking industry is a barometer of the economy. So the slowdown in the economy gets reflected in the slowdown in credit growth vis-a-vis the overall output, and assuming even a 6.7% growth next year with, say, inflation of around 3.5–4%, we are looking at a nominal growth of less than 11%. And we have traditionally seen banks grow around 1.1, 1.2x of that. And Federal has been relatively better amongst the banking industry growth. So whilst in the last earnings call, we said we will target to grow around 1.5 times the nominal GDP. So at this stage, whilst the horizon in the near term is very cloudy and not certain, we do expect by FY26, as the quarters play out, we should start getting more clarity. However, a large part of the capex in the industry has been driven by government so far. We also have to wait and see how much of that is sustained and how much of private capex starts coming into play, because we do need to see capital formation. This slide talks about both the average lending and average deposit rates over a period of time from September 22. I've taken the reference point. There is a line from March 23, and that's when the rate was at 6.5 repo rate and stayed on till about a few weeks back. What is interesting to note is that whilst the lending rate has been relatively flat, the deposit rate, average deposit rates, continue to have gone up and stayed at that levels and continue to be firm. This is also reflective of the tightened liquidity in the market, and we all have been seeing that whilst RBI is trying to take various steps to ease the liquidity, but as we speak and in the near term, we don't expect deposit pricing to soften in a hurry. It will take some more time for the deposit pricing to start reflecting the repo rate cut. On the right side, you can see the percentage of, this is just on the floating rate for the industry, how much percentage is EBLR and how much is MCLR. Whilst there are different views from economists on what the rate cycle would be in the April MPC, at this stage, this view that there'll be one more rate cut, but we'll have to wait for data to see how it plays out. And then, but since the stance is neutral and the inflations are coming under control, there is all likelihood that we may see one more rate cut happen in April. The next slide, I'll talk about some of the BFSI indicators. The first one on top left is on UPI. The reason why we chose to show this is the pace at which the UPI has kind of grown over the last several years and continues to grow. This also means that the enormous investment which banks are making in the IT infrastructure, we have to keep pace. And what is also happening is, amongst all this, is the number of, and as digital transactions increase and get sophisticated, the digital frauds are also multiplying. And those are things which banks are now looking at how to curtail, curb, spend, or rather put in monitoring tools for that. I'll cover that later in subsequent slides at the later part of the session on what we are doing on this aspect. Mutual fund AUM has been growing steadily. This is an area of opportunity, both mutual fund and insurance space. And why we feel excited about this will get covered in Manian's session when he talks about what are the opportunities we plan to seize in this space. I'll just skip the slide. This is an important slide in terms of the industry landscape and regulatory priorities, because each of these have an impact and bearing. Credit deposit growth dynamics. Last year, many of you know, were some banks who received letters, some of them had soft messages on managing CD ratio. But what is important to note is that when credit growth has been running ahead of deposit growth, maybe in the short term it was good, but at an industry level, there was a need to make sure that it was under check. For federal, you all know we have always been operating at the 80s level, probably 80 to 82, 83 levels. And our philosophy of fund before lend is something which we have tried to maintain throughout. Financial innovation is a space which again is seeing a lot of action, not just from the private players of fintech, but RBI in its own way. RBI Innovation Hub is driving a lot of financial innovation. And the recent one has been on mule accounts. We partner with RBI closely in all the pilots. And we do see a lot of things coming out of this space on the RBI innovation, including the industry, other players in the industry. Liquidity and ALM management on the LCR is again another thing where we saw regulatory guidelines coming out, and then which was later subsequently, I'll cover that towards the end, where certain things have been deferred to next year. Unsecured retail lending, this was the one which was the first kind of area where the regulator put a kind of saying that growth is very fast, probably money is getting channeled into equity markets and other places. So this was, I think, November 23 was the time when they asked banks to slow down on the unsecured retail lending space. Credit flow to MSME, again emphasized in the budget as well by the government. This is a space where falls quite well into our, what we want to be the SME bank of choice. So plays in quite well into our strengths. And this is an area which we will emphasize, as you will see going forward. Cybersecurity and digital. I don't know how many of you remember 19th of July 2024. Something very important happened. It was the CrowdStrike, and Microsoft had a global outage. It brought the entire industry down on its knees, and the impact which it had. And subsequent to that, whilst RBI was already quite on top of it, the emphasis which is there to invest in IT security, cyber, is only going to go up. And we, if you recollect our messages in the past as well, investments in control functions, in IT, audit, compliance, cyber security is non-negotiable. It's a zero tolerance area for the bank, and we'll continue to invest. So are other banks. But this is something which we will continue to see investments as we go along. The last one is what I covered in terms of strengthening the assurance functions. And all regulators, it's not just RBI. I know there are so many other regulators who are coming into play in terms of strengthening governance. And the latest one being NFRA, NAFRA through ICAI, are also trying to make sure that the governance standards, audit standards, everything are maintained at international levels. There is also a move by the government to try and bring down the reliance on global cloud and data centers. So government is working with certain players doing a pilot on having their own data center. And it's only a matter of time when we'll see that will get launched. Probably banks will be nudged to move towards that. And the last part of the slide at the bottom are those points where the first 3 points have been deferred. In the last policy meeting, they mentioned till next year, April. And the potential refinements on overlaps between group entities is something where banks have responded. Those impacted entities have responded to the regulator. We'll now quickly move to how Federal Bank has performed in terms of last strategy meet And now, when I said last, like I said, FY20, because of COVID, there was a 1-year break. So in 23, we had a meeting to take stock of where we are. And the reference point is FY20 to FY24. We had a CAGR growth of about 14.5% on advances, and very closely followed by deposits around 13.6. So the endeavor to make sure that the deposit growth kept pace was pretty much evident. We had seen improvements in all the parameters, and the targets which we had set at that time were met, including the ROA, ROE targets. And more importantly, our risk appetite continued to be moderately conservative, and the asset quality continues to be pristine, because these are things which is the pride of Federal, and we are not known to be taking too aggressive bets on any particular sector. We will continue to maintain that as we go along. This is in terms of the momentum over the 4 years. In terms of CAGR, both on NII, if you see, we had a CAGR of 15.7% and fee income of 13.6. Typically, I'm sure you remember this message, which has been reiterated. We would like the NII to grow faster than the credit growth, fee income to grow faster than the NII. Whilst the fee, there's still room for us, and there's a lot of opportunity to grow the fee income, which you'll see in subsequent slides when Manian comes up and talks about the strategy for the next 3 to 5 years. What it shows is the opportunity for us to perform within the same risk appetite is enormous. And how we plan to tap into that is something which you'll get to see. At an OP level, the CAGR was only 12.7. There was investment in new branches, investment in technology, and tech spends in FY20 was less than 4% of the OPEX. Last year, we ended at 6.8%. And the plan is it will go up to around 7.5% as we go forward in the next 3 to 5 years. So this is an area which we'll continue to see. And as you all know, technology is evolving, changing so rapidly that what we do now after 3 years becomes irrelevant. We may have to then redo the whole thing. So with that as the backdrop on the economy, the banking industry, and how Federal has fared till FY24, I'll now request Manian to come over and take us through the next leg of Federal's journey. Thank you.
Thank you, sir, for your insights into our financial journey. It's my privilege to introduce our MD and CEO, Mr. KVS Manian, who leads Federal Bank's growth and strategic direction.
Hello. Good evening. Good evening, everybody. To begin with, thank you very much for showing keen interest in joining today in our this event. I am truly excited standing here before you. I think it's if I look back at Federal Bank's history, it's a 93-year-old organization, and it has a hallowed history. As you can see, the first few years of 3 decades of nascent era, next 3 decades of what I call the checkered era, and then, of course, last 14 years under my predecessor, kind of a resurgence back to reckoning. What gives me that excitement is that I think we are poised to take the bank through a breakthrough period where we can really create a modern franchise which is truly national. I think a lot of effort has gone in through the last 14, 15 years to take it national. And I think there is an opportunity to create a truly national franchise and, of course, move the bank to a peer set which is more the private sector banks. Federal Bank has generally been treated as the mid-sized bank or the old private sector bank. The opportunity for us, while old private sector bank and maybe a fact and we cannot change that, but I think if we can change our peer set, how people look at us as the top private sector banks is what the opportunity is. And over the next few years, if we can start a journey towards creating a universal bank, because the top peer set that we want to be compared with are all universal banks. If you take the top 4 banks in India, all of them are universal banks. So we need to begin our journey to take us somewhere there. And this is what gives me a great sense of excitement, because standing today, I think the opportunity is to create that breakthrough moment from here. And that's why we are calling it the chapter 4 of Federal Bank's history. And it's my privilege to be heading the institution at such an important point in time. One of the things that many people told me is that, what are you going to do in the first 100 days as the CEO? And in fact, my response to that has always been that I think for an institution like Federal Bank, which has such a great history and heritage and legacy, for a new CEO to come and start doing something is probably being unfair to the legacy of the bank. And it was important for me to get a sense of what the bank is, sense of what the DNA of the institution is, sense of what the strengths of the institution is, what are the aspirations of its people, what do they want to do. So what I did essentially was, I thought the first 100 days are gainfully spent in what I called the listening tours. And I traveled across the country. I have traveled close to 15 locations, including our foreign locations where our people are present. And I have met close to 2,000 people, almost every single branch manager and upwards. I have met most of them. And those discourses, and I had also met some very bright young people who are not necessarily managers, but who I would say are the future of the institution. I met close to about 200 of them, and basically tried to understand what are the things that they are thinking about, and what is it in their minds that they think the bank should do. Because most times, the people who know best where the institution should go and where the limitations of the institution lie are out there in the front line. I would say that the first 100 days that I spent talking to each of them was really a learning and quite instructive for me. And there were several questions in my mind. So this is kind of musings that I had as I went through these meetings. And in fact, one of the things everybody, and these are things not necessarily that were in my mind, these were in the minds of people of the bank. And so the questions that we are trying to answer while formulating strategy, because it's easy to write a strategy for a bank on a white paper, but if it is not contextual to the organization and its DNA, its strengths, it is a meaningless exercise. And therefore, these musings together, talking together, was very, very important. And these are some of the thoughts that occurred to me and to the people as I gathered from them. So how do we enhance our profitability, still sustaining the growth momentum? Like you saw, Federal has delivered 14-15% kind of growth rates. We have to continue to sustain and even make it better. But how do we sustain that while improving profitability from here? Because our ROE needs to get better. How do we instill P&L culture in our business heads? Most of our business heads are quite focused. They deliver quite well on targeted volumes. However, there is not a profit orientation in terms of what profits each business is making. And how can we get profits to be shouldered by not only the CEO and more people in the organization. How do we move from a price-driven, affordability-driven sales to value-driven sales? So these are some of the key things that were going on in our mind. Kerala and beyond Kerala, this is a very important duality that exists in the organization, because for all practical purposes, we are the Goliaths in Kerala. Our market share is nothing. The only institution that can talk of larger market share is State Bank of India. So our market shares are really impressive in Kerala, and we are the Goliaths. But the fact remains that in rest of India, we are still the Davids. And this is the difference between Goliath and David, incumbent and challenger, those kind of mindsets. And within the same organization, we need to manage this duality. And therefore, how does the head office sitting in Kerala relate to the challenges that a non-Kerala outpost there faces? And how can we create a challenger mentality in some part of the organization while being incumbents in one large part, one state? This is an important thing that needs to go into our minds when we chart our future. Branch model. I think a lot of our branch banking is structured relatively in a legacy format, where a lot of stuff that gets done at the branches, most new private sector banks would have moved them off from branches to either regional, central, or some other location or excellence centers. So how do we change the branch format to make sure that the branches are highly liability centric? Our branches do both assets and liabilities, but the relative importance of liability, how do we change in their minds the relative importance of liability? And therefore, how do we make the branch model liability centric was very critical. From whatever I have heard from customers I have met all through, our service levels are excellent, our NPS scores seem excellent, and therefore there is a great goodwill among customers on the service levels of the bank. The question is, how do we convert the positive sentiment arising out of service into selling them more products and the sales? How do we create more of that? The other one, of course, is as I said, it's a 93-year-old institution, and therefore the brand has certain legacy perceptions. How do we create a brand with a slightly more zing in terms of the lower generation, younger generation? How do we create a brand salience in the minds of non-Kerala people? How do we enhance all that? How do we create, if you look at our data on business banking, our current account traction is relatively lower. How do we create a bank with focus on SME? How do we get SMEs to be excited about our brand? Which part of corporate bank we need to focus on to create a more profitable model? Again, these are questions that are in the minds of every employee, every leader in the organization. And last but not the least, people related. We are a bank with attrition rates which are annual attrition rates equal to monthly attrition rates in many banks. Yeah? So our attrition rates are phenomenally good. How do we leverage that for better outcomes for us? How do we, at what point in time the balance between performance orientation and lower attrition we balance? What kind of balances do we strike? How do we create a team which is what I call a AAA team, astute, alert, and agile at all times? It's a mindset, being astute, agile, and alert. How do we create that kind of a team? So these were, again, thoughts that occurred to me, and these need to go into what we plan for the future. So if you ask me what should be the bank, how do not only me but all my team want to see the bank in next 3 to 5 years, what is the vision for the bank for next 3 to 5 years? This has come out of those discussions we had. If you see clearly, one area is NR. NR is a moat that the bank has created over a long period of time. It is a strong point of the bank. It has a huge a market share. It is one of the largest market shares in the industry, close to about 7% on the deposit side. In fact, on the NRE side, it is even more. So it is a moat that the bank has created and worked on for several years. In fact, 20% of the remittances that happen, personal remittances that happen into the country across the globe, happen through Federal Bank. That happens through our customers as well as our partners. So we have a big moat here. How can we, of course, we have a great share of the GCC Kerala axis. The question is, how do we enhance this moat by expanding beyond Kerala and beyond GCC? And as our branch network grows in the country, there is an opportunity to do that. And we are also looking at how internationally we can have presence in more places where we can grow this segment. And so therefore, and the third aspect of that is, we have relatively focused this franchise on the deposit side of the business. There is opportunity here to superimpose the wealth element and create even more value through this franchise. So this is clearly one area where we will build further on our strength. And this is an area of existing strength which we will build further. The second is what I call the affluent banking. I think Venkat touched upon it. I think this has if you look at some elements of affluent segment products, we already have. We have a home loan product, we have a car loan product, we have, of course, a saving product targeted at the premium. We have some elements of it, but the key element missing in my mind is, again, the wealth management part of it, wealth distribution part of it. So what we want to do there is create more linkages to capital markets, create more propositions around affluent banking, and create a more stronger proposition. We have some elements of it. With addition of wealth into that, I think we can create a winning mass affluent proposition. So this is going to be the second focus area for the bank. And the third is to be the SME bank of choice. This is actually not necessarily the area of strength today, yes, but having said that, our businesses that have grown among the fastest in the last few years are the SME lending business. So the lending part of this business we do have. It's not that we don't have. I think there is opportunity to do more current accounts, more trade and forex, more cash management business in the SME area and drive our profitability through that. Here again, we can create a differentiated proposition and create a bank of choice for SMEs. So this will be our third segment of focus that we want to do in the next 3 to 5 years. And the last segment is about corporate banking. We do believe that a bank of our size can be more profitable serving the mid-corporate segment because that gives us a more holistic bouquet of products to be sold to a customer and drives the profitability of the relationship at the relationship level much better. So I would say powering mid-corporates, mid-market corporates is the fourth segment that we will focus on. As I earlier said, all this, of course, we do at the back of creating a truly national franchise. We will talk more about it later in our slides, but we want to create a truly national franchise and modernize the franchise. I talked about how our branches are still, some of them are in legacy formats, which we want to correct. And as we go forward, we build towards a universal bank model so that we can serve our customers with multiple products beyond vanilla banking. Leading all this, hopefully, will lead us to the top 5 private sector banks in the country. And this is our aspiration over the next 3 to 5 years. This is where we would like to get. While we do all this, some fundamental pillars or some principles that we would like to keep in mind and always follow are some things that I have put here. Profitable growth is, of course, very, very important. While we scale up, we don't want to scale up mindlessly. We want to be mindful about how we scale up, how we can scale up profitably. That doesn't mean, I'll come to the risk part of the graph in the middle. That doesn't mean we'll not take the optimum amount of risks in the business, but we will remain focused on prioritizing sustainable, long-term, capital-efficient growth. And we want to ensure that the quality of earnings we produce is superior, and we'll remain focused on that. Of course, that also means that we have to scale up smartly. Scaling up smartly means many things. In some businesses, partner versus own can be scaling up smartly. The right balance can be scaling up smartly. In some businesses, it can be optimizing capital. In some businesses, may be more important. As we expand footprint, managing productivity is, can be scaling up smartly, meaning of scaling up smartly. How much technology, how cost effective is technology deployment, and what are the outcomes out of that is about scaling up smartly. So there are many elements of scaling up smartly. We want to make sure that while we scale up smartly. Winning the 4 segments that we talked about, we need to redirect our energies to make sure that we are acquiring customers for those 4 modes that we want to create for ourselves. And that's what winning the right customers is all about. We will create right focus, right energies, right structures, organization structures to make sure that we win the right set of customers. Of course, all this means that the repositioning for the future of the brand in terms of those 4 segments will be very critical, and we'll have to change some legacy perceptions about the brand to make sure that we appeal to those 4 key segments. Technology, of course, banking without technology is unimaginable, and technology will remain core to how we grow from here. Culture of high performance is another critical pillar that we will want to create. We are in the process of creating scorecards for every profile, making sure that the right jobs are manned by right people who have the right sales attitude, sales skills. All of that is very important, and therefore that is one more area which will be one of the pillars of how we take this forward. And last but not the least, for doing all that, risk and compliance standards are non-negotiable, and therefore we will make sure that we strengthen these functions, and together I think all this can lead us to where we want it to be. I just want to spend 2 minutes on the graph in the middle. This is one way of explaining how I'm not talking of credit risks here necessarily. I'm talking of business risks. I'll give you an example. We today source almost 70% of our cards from partners, through partners. And we have an economic arrangement which limits our initial costs, but it also limits our upside in the future because there is a sharing, which is what is represented by this line, right? So it limits the upside, but it limits the initial risk as well. Yeah? But in some areas, for argument's sake, if I take that example forward and we acquire more organically, more cards, what it will mean is we'll have to take the acquisition costs in the beginning, and therefore the losses will be higher, but the upsides will be also higher in the future. And some of these, I can give many examples like this, where our approach in general has tended to be this. Of course, this is valuable, it limits the risk of the organization. But having said that, in some businesses, we'll have to be bold and we'll have to take the second approach rather than the first approach. And we will do that in some of the products. And I do believe that that's what will give us breakthrough kind of outcomes. And this is a very important shift in the mindset that we want to make in terms of being slightly bolder on some products. For example, wealth. Our wealth arrangement did give us a low downside cost in the beginning, but it has also not given us major upsides. So if we want to build that, we'll have to take costs of setting up that wealth business for a better outcome in the future. So there are many examples like this, but this is a key change in mindset we want to bring. And that's what this breakthrough, I would say these are the pillars or tenets on which we will do the breakthrough project. So internally we call this the project breakthrough, and there are 12 elements to what this project breakthrough is about. We will go into each of them in detail. I will pause here, just let you eyeball this for a moment, just you can eyeball this. We will of course go through each of them. Yeah? So there are 12 themes that we have for the project breakthrough. So starting with the first one is NIM. You know, whenever somebody talks of NIM, okay, let me, because this is an important thing, this you will see again and again in various slides. So let me explain this graph to you. What we have done is we have taken the top 6 private sector banks and created for that parameter what is the best 3 and what is the next 3. And our general aspiration, these numbers are not important here because these numbers will keep changing. You know, NIMs may look different 3 years later for all banks, right? But what this is telling you is what is our positioning aspiration that we have. So we want to lie somewhere between the next 3 and the best 3. And that's the direction. The numbers may not be exactly the same. The arrow indicates our journey towards that. So this chart you will see in all our slides. So just coming back to NIM as a concept, I think NIM improvement is an imperative for us. And most people, when we think about NIM, they immediately think of high yield assets and therefore improvement of NIM. I believe that the NIM game is more important to be played on the liability side. It is relatively risk-free and it is more sustainable, and therefore I think the liability side impact on NIM is probably much more important than even asset side. I'll come to the asset side, but on the liability side, obviously I talked about reorienting branches to CASA, focus on CASA and deposits. I think this is something that we have already set in motion. We are seeing very good results already, and therefore this is one important thing that will happen. The branch scorecards have changed. They give much more weightage to liability and deposits, and therefore that is something that we have already on road to, and this is an important change that we'll make. The second is strengthening the CA portfolio. If you look at our CASA, it is a breakup of 30 is 24 and 6. 24% savings, 6% CA, current account. If you look at the industry, this figure is not dramatically different on savings for most the top players. They'll be, if not 24, they'll be 26, 27, 28, not more than that. But the CA can be from 6% for us. The best players could be even at 14, 15%, some definitely at 12, 13%. So we think the upside is on CA for us. And it is a positive both from cost of funds and opportunity perspective. So we are very clear that the focus on CA is extremely important, and CA mobilization and therefore impact of that on the cost of funds. So we'll have to create CA products, we'll have to create propositions around CA. This again plays well into our small businesses as well. And we are already seeing record CA openings in the last 3 months. We have already changed focus, and we are already seeing impact of specialized focus on CA as a important element in the branch's outcomes. The third is what I call engagement with capital markets. Capital markets are essentially high transaction, it's a high transaction ecosystem, right? So any customer who, if our customer engages with capital market and uses our account, it gives us more transactions and therefore better CASA. And somewhere this is an area where I think we want to make a dramatic change, whether it is in NR PINS account or it is 3-in-1 accounts which are linked to our accounts, ASBA, all of that. I think even in the wholesale side, if we are focused on segments which are capital market oriented, I think there is an opportunity for CA and SA from higher engagement with capital markets. This is again a mindset and a focus issue. I think we think we can make a difference to our CASA through this. And of course, I talked about NR beyond GCC and beyond Kerala already, so I will not repeat that. And segmental propositions. Again, I think we have to improve our segmental propositions, which we plan to do. We do have some segmental propositions, but they are limited. For example, wealth relationship value is not part of our customer relationship measurement. So we'll create better, more holistic propositions which will improve our customer engagement, improving the probability that we are their primary bank. And therefore, and we have seen a primary bank to a secondary bank, the uplift in CASA can be 2x to 3x. So I think it's important to create segmental propositions, and last but not the least, granular focus. I think while, of course, we will continue to use opportunistically the wholesale markets to fund our balance sheet, our focus will be to create a granular franchise, CASA and TD, which will be both cost efficient and LCR efficient. So if you look at our CASA ratio, we are saying in 3 years we should aim for 30 to 36. 4% out of that 6% must come from current account and 2% must come from savings account. This is something that we want to commit ourselves to and make sure we make this journey. And at 36 at the end of this period, at least we would have reached the industry average, close to industry average by that time. And that's currently we are below the industry average. We want to get to at least the industry average by that time, and then of course take the journey further from there. And by that we are hoping that our cost of funds benefit will take us to somewhere between the next 3 and the best 3, maybe slightly above the next 3. On the asset side, again, yes, it is important to do high yield assets, but we know that creating a dumbbell of high yield assets on one side and low yield assets on the other side for growth is not the best of ways to grow our balance sheet. So we want to be mindful of that. So if you look at this, I did mention in our analyst call, last quarterly call as well. We want to focus on what we call the medium yield assets, which is the LAP, the SME businesses, the business banking assets, the commercial banking assets. These are areas which give you medium yield. They are reasonably secure assets. They are commercial vehicles. There are many assets which fall in the medium yield assets. So we want to first focus, just now while the environment remains harsh for unsecured lending, we want to focus on what we call the medium yield assets and get them to grow. And as the environment clears up, of course, we will grow the high yield assets as well. But I'll come to the desired levels of proportions soon. Second, of course, there is the mid-market corporate lending. Again, we feel it is at least better rates than focusing on the higher-end corporates. Priority sector, again, there is opportunity here to not only avoid negative yield assets on the balance sheet in terms of RIDF and things like that. We, of course, don't do in the last few years. We have managed to meet our priority sector norms. But having said that, I think there is opportunity there to make more revenue and better yields if we push more on that front. And we see opportunities there. I already talked about the high yield assets. And last but not the least, again, is an optimized RAROC-based pricing strategy. Is already we are in the process of rolling this out. We feel that we need to bring more science into pricing assets and make sure that we get duly rewarded for the risks we take. And therefore, we have already kind of semi-implemented RAROC-based pricing model. We will, of course, do a full implementation going forward, which basically not only credit risk, tenor risks, all of that is well priced in that. Of course, in all this, markets must permit us to do. In some products, markets sometimes remain irrational. Of course, we'll be mindful of that. If we want share in some markets, we might have to look at the science, but use some art there. But having said that, it's going to be an important cultural shift we will make. So at the end of the period, what we think is we will get 64% low yield assets, which is our corporate home loan and those kind of assets, down to 58%. Medium yield assets up from 31 to 34%, and the high yield and very high yield assets from 5% to 8%. And this will give us some uptick on the yields. But like I said, we do not want to dramatically shift the risk pendulum on assets. We see bigger opportunity on the liability side. We want to shift the pendulum a bit, but not dramatically more, and change completely our risk appetite. Like that is one of the DNAs of the organization where it has held us in good stead. Our asset quality has sustained through the cycles, and it has remained reasonably strong over the last decade or so. So we don't want to dramatically alter that, but yes, tweak it a bit to get some better yields on assets. And we fall in between the next 3 and first 3 in terms of yield on assets, but we can probably push it slightly more to the right. That's the way we see the assets. And of course, this will therefore combination of both these, and here I'm just clarifying, I see bigger benefits coming out of the liability side than asset side, but nevertheless, both together will place us somewhere, our journey towards somewhere in the middle of the next three and the best three. The theme 2 is, of course, to fuel growth. Of course, we have a current product suite which can grow. There is still growth potential in most of our products. We will talk about that later again. But we also are thinking about adding new products to the suite which will fuel growth. And of course, one of the key ones that I already talked about is the fee part of it, which is the first one, investment products, where I think this is an area where I think we fire less than the peers that we would like to compare ourselves with. And therefore, there is an area of opportunity. We have the relationships, we have the client base, we have clients who have large deposits with us, and I'm sure all those clients have money in wealth products, which probably they are going to somebody else to get it serviced. The attempt is to get that revenue share, wallet share to ourselves, and I think there is an opportunity there. So that is one area of new product portfolio. The second is a set of products on the retail and commercial, which is scale up used vehicle finance. Again, car and commercial vehicle, our used vehicle business is very, very minuscule in our portfolio. We want to push that envelope a bit on that. These remain secured, but yes, of course, slightly higher risk, but higher yield on, and we think the risk reward is still good. So scaling up used vehicle finance, both in CVC and car loans is and even CE also, the same thing applies. We also want to look at micro lab products. We are dealing with those kind of customers in our agri as well as microfinance business and gold loan business. So there is an opportunity to create a micro lab product, which is again a secured product. So we think that is an opportunity. Tractor finance is again a great opportunity. We have been a reasonably long-standing player on our agri business, and therefore tractor can play well into that segment, and therefore we think this is a product that we do not have in our suite, and we can launch that and grow that business. EMI based unsecured business loans is another product that we think we can do with our current BUB and commercial bank customers, and our focus on new current account customers. I think this product sits well. It's a good cross-sell product. New acquisition on this product can be expensive or risky, but on existing customers whom you know well, this can be a product which can be a yield enhancement kind of a product, and that's why we think we should do that. And affordable, the housing loan at the top end is really a highly competed low yield product, and you saw that chart there. It sits in that low yield bucket. So affordable housing is again something that we are looking at, how we can launch affordable housing to get better yields. On the corporate side, I think real estate finance is an area. Traditionally real estate has this negative connotation that it is a high risk product, but I can tell you from my experience of having done for more than 20 years, I never lost money in any real estate lending that we did. And therefore, I think if done properly, if done judiciously, it's a good segment to go. And the RERA and those kind of regulatory changes that have made the sector safe. Capital raises by that sector has made it safe. So there are multiple reasons that sector has become safer, and therefore we think, again, a product which is a medium to high yield business that we can create is something. Real estate finance is something that we can do on the wholesale side. Sustainable finance can, of course, can be across retail and wholesale segments. On the wholesale side, of course, we all understand there can be financing of renewable energy and things like that. Even in the retail side, we can have EV financing and things like that, which are, of course, we have to be careful in some of these. At the right risk-reward ratios, it may be worthwhile looking at some products around sustainable finance. Then, of course, three areas of wholesale, which is correspondent banking, syndication, and capital market services, are areas where we think we have a relatively smaller moat in these products, but these are things that can improve the quality of our corporate bank earnings, and we want to remain focused and make sure that with these products we improve the quality of earnings and ROEs of our wholesale business. So kind of product suites that we can over next 2-3 years launch at regular frequency, which can build, help us build either our fee momentum growth momentum or the asset book growth momentum, both on the retail, commercial and wholesale side. The third theme that is important in terms of strategy is of course the fee enhancement strategy. We see key opportunity areas in 4. Trade and forex income first. Again, compared to our peers whom we want to be benchmarked with, we can see a clear difference between the levels of revenues we make on trade and forex compared to what our competition makes. And therefore, I see an opportunity here to scale up this revenue. And as we focus on the mid-market and the SME businesses and the current account, I think this plays well into that whole theme. And therefore, this is an opportunity area where we can grow. I already talked about wealth management and bank assurance. Our bank assurance practice is reasonably strong. Of course, we can, as we get more focused on wealth as an overall suit, even outcomes on that could be improved. The third is credit cards and acquiring business. Again, credit cards is a small business yet for us, and it's a high fee oriented business. Acquiring business is again fee business, and therefore this is an area again we want to focus. And credit cards also plays well into our mass affluent proposition that we talked about, and therefore these are all correlated. Cash management services, again, of course, cash management services can give us fee or CASA, CA essentially. It plays into both current account, it plays into the current account strategy as well, and it also has fees at the lower end of the market. And cash management both for retail and when I say retail, small businesses and corporate is an important piece of our strategy going forward. So, and all these 4 some of these can be co-originated with the products when we onboard the customer, and some of these can be cross-sold. And both these strategies are very important in getting these 4 things going. For example, just as an example, can we board a current account along with cash management services? Yes, we can. Can we board a savings account along with SIP on the savings account? We can. So that's the product co-origination part. Of course, cross-selling on existing base is important. So, and again, all these 4 speak to the 4 segments that we talked about, that is mass affluent, NR, MSME and mid-market. And therefore, of course, there are other elements of fees which have to grow, but these are 4 critical opportunities where we think we benchmark. When we benchmark ourselves, we have an opportunity vis-a-vis our competition. And this is what will drive our other income and fee income growth. Of course, in some of these areas, we'll need to acquire talent and reskill our people, especially, let's say, in wealth or a trade forex kind of area. We'll need, even cash management is a slightly technical area, and it may require reskilling some of our people. So I think to get this going, we have to make sure that we are able to either acquire talent or reskill our existing workforce, both of which we will, of course, do as part of execution of this strategy. The fourth, of course, that everybody asks, what is the branch strategy? There is a, on the branch strategy, we want to not just do some branches all over the country. I mean, you land up doing multiple branches across the country, just every state does not come alive, or every city does not come alive. For example, in Bombay, we have 19 branches. Our nearest competition amongst those 7 branches will have close to 100 branches. So it doesn't bring alive our brand. So what we are thinking about is a more concentrated strategy and a phased strategy where we bring alive fewer locations, but we bring them alive truly. So the strategy is a phased expansion. So we want to pick some of these states first, then move to these states, then move to these states. Yeah. So let's say Tamil Nadu, Karnataka, Maharashtra. Maharashtra has a background for Federal Bank, right? Several years back, Ganeshkind Bank was acquired by Federal. and therefore we do have some penetration in Maharashtra as a state. So we want to go in a phased manner. In a year, we don't want to pick all states and expand in all states. We want to focus on specific states and expand so that we can bring alive Maharashtra or Bombay, right? So that is one part of the strategy. So, second, what we are saying is we will initially focus over the next 3 years on top 10 GSDP states. Rather than trying to do everything everywhere, we will focus on top 10 states, get more branches done in those, and of course, that doesn't, what this means is 80-90% of our branch expansion will be focused on these states. So we will focus on that, and selectively we will also pick some tier 2 cities which may not be in those state priorities, but some tier 2 cities which we see potential in. And of course in metros we want to go at a pin code level strategy, and therefore we want to make the branch expansion strategy a slightly more thoughtful strategy than just spraying the branches across the country with whatever comes our way kind of thing. So we want to apply a bit more thought and make sure that we the outcomes we can get by putting those branches really justify our expansion strategy. So however, you know, we are looking at adding about 400 to 450 branches. This is always, we can always review this. If our outcomes look better, nothing stops us from going faster, and if outcomes don't happen, we have to make sure our outcomes happen, otherwise we should not, otherwise we do not have wiggle room on our cost to income ratio to do this mindlessly, right? So we'll be very thoughtful about this whole process, and we think even at the end of 3 years, we'll be probably at the lower end of the top 6-7 branches in terms of branch strategy. But like I said, our bigger upside is in getting better outcome from existing branches, improving the productivity of our branches. If you look at our deposit per branch and CASA per branch, I think there is an upside possible, and we have to juice that out before we get more confident about putting even more branches than these. The fifth, I was talking about, theme 5 is about branch transformation. I was talking about certain legacy aspects of our branches. So what we want to, there are a lot of activities today the branches do which we can do cheaper and better away from the branch. This is something that we want to drive. One of my favorite, in fact, you know, when I went across the country, the cry was around how the branches are overloaded with a lot of operational work and how they do not have time to engage with customers. Yeah? So one of the primary things we want to do is get all those activities out of the branch and make branches the point only for acquisition, servicing, engaging, and selling. This is the only thing they should do. All the other activities we can profitably do by moving them away from branches. And how to move them away from branches is, of course, we can eliminate some activities, we can automate some activities, we can centralize some activities, and in some areas like collections and trade, processing and things like that, we may have to regionalize activities and conducting them at the branches. Branches are obviously manned by high cost resources at a high cost premise, and therefore we have to optimize costs and change the branch formats. This is something that we are beginning to do, and we have identified an existing person who will man this project, and this is a very a project very close to my heart, and we are going to modernize our entire branch formats as we go forward. And then, of course, expanding sales and distribution capacity. Again, wealth RMs have to be different. Personal banking RMs can be different, and business banking RMs can be different. And you can produce different outcomes if you deploy them rather than putting one kind of an RM to do everything. So there are things where we have to, or sales kind of people can be lower cost and we can deploy them in higher numbers than we do today. So there is a optimization we can do by in cost and still expand our sales and distribution capacity in the branches. And third, again, I found that the branch manager's role, because of all those pulls and pressures and all the calls on his time that happen, it's not a sought-after job in the bank, and we have to create. One of the things with our HR team I'm trying to focus on is how can we create the job of a branch manager as CEO of the branch, and how can we create excitement around holding that role, whether by defining that role better, making it simpler, measuring it rightly, rewarding them suitably, all of that. So we will look at all that, and of course digitization. There are lots of manual activities in the branch which can be digitized. So this is one thing that I believe can lead to significant either capacity to engage with customers and acquire customers, or cost reduction. Hopefully we'll first do the first element rather than the second element. Theme 6 for me is what I call the brand transformation. I did talk about certain salience outside the home market is still an issue, and we need to address that. While we continue to reinforce loyalty at home market, we need to build salience for the brand outside the home market. And we, like I said, there are some legacy perceptions around the brand which we need to redefine and contemporize the brand for a younger generation of clients. And if we have decided those 4 segments to focus on, the brand must speak to those segments, and we'll have to create the right conversations of the brand with those segments, and therefore positioning the brand for those segments will become critical. Redesigning our branches and brand is an important element going forward. And last but not the least, again, we do intend to create an ATL campaign and with a brand ambassador. Hopefully we'll announce that soon. And we want to create a bigger brand salience across the country. Of course, it's easy to spend money on advertising, so we will be mindful about how we do it and how efficiently we do it. But I think it is a crying need of the brand to be recognized beyond the home markets in a manner that the other private sector banks, the top private sector banks, get recognized. And we have recently done a Nielsen survey and figured out where our brand stands vis-a-vis other brands. And there is clearly evidence of the fact that the brand salience and recognition and top of mind recall and consideration scores can be much better. In Kerala, we beat the charts. We are out of charts kind of numbers. But outside Kerala, there is still a lot of work to be done, and this is an area where we will spend energies in making sure that we provide air cover for our teams, whom we will task with more focus on client acquisition. Theme 7, of course, technology. And we have always followed this mantra called digital at the fore, human at the core. We do believe, as you saw, the human relationships, we believe, are critical to our business. We'll continue to follow that philosophy, and we have customers who have banked with the bank for generations and continue to bank with us. So it's a huge strength area. The human relationship is a huge strength area for the bank. And in general, our teams are highly relationship oriented, which is a great thing. And we continue to encourage that kind of DNA. And however, digital is a reality. We need to make sure our digital propositions match our human relationships, and a combination really keeps our customers engaged. And when I look at digital, there are 2 aspects to it. One is the user and customer engagement kind of activities, and not enough attention many times goes into the employee enablement side of the technology implementation. So if I look at the user experience side, of course, mobile, we have a reasonably good mobile app. It does its job. It is rated reasonably well. But of course, is the technology absolutely contemporary? No, it is based on a legacy technology. And while it does its job well now, looking forward, we need to redo our entire platform, and we need to create an omni-channel kind of a platform which will render mobile, net, or any other channels, right? So this is a project that we have already put into motion. Chatbots is another area. In fact, we are one of the early adopters of AI in many areas. For example, we are an early adopter of Copilot as a AI engine, which helps us manage our communications, minutes of the meetings, and things like that. So it's an area where we are already quite proactive in. But having said that, we want to use GenAI chatbots as customer assist or employee assist. Both are very important. And of course, Venkat will talk more about it later. Wealth management solution, as we scale up our wealth, I think we need the entire technology suite relating to wealth is, of course, more or less absent. So we need to create that, and we need to create tools because here mass affluent and affluent will behave differently. We need to get affluent from a experience and service delivery perspective. We need to deploy technology, whereas in the mass affluent we need, even for transactional capabilities, we'll have to deploy technology. So our platform needs to be needs to have the capability to do both. So this is another area that we will focus in terms of technology. And the last one here is the corporate and SME portal. Again, speaking to the two segments that we want to focus on, we want to create a corporate portal which is comprehensive in its nature, delivers trade, FX, cash, transactions, all of that in one place. And this is some project that we will, again, focus on. These are key user experience projects. Employee enablement, there are several, but the 2 or 3 that I would like to bring or call out are unified onboarding, customer onboarding systems. We have 12 or 13 LOSs for each product doing a loan origination system. We want to unify them, get them onto the similar platform. Again, similarly, account opening process, we have multiple platforms which onboard customers. So again, unified account opening is an important project. Virtual agent assist is again a very, very interesting project that we are working on. This can be either, of course, taking the call on its own or being an assist for a call center agent and improve his response quality and response times. So I think some of them, some of the others I will not go into, but clearly there are specific projects that we have already kicked off in this area. The other one is, of course, renewed digital distribution strategy. Most of our digital distribution has till now been partner-led, whether it is credit cards or savings account. We'll come to personal loan separately. Large part of our digital acquisitions have been partner-led. We have digital acquiring partners who have helped us acquire these products. Going forward, we want to find some more balance in that, where we want to create our own capabilities in digitally acquiring some of customers for these products. And therefore, we are saying we will create capabilities, digital acquisition capabilities, digital marketing capabilities within the organization to balance this, so that we don't place, we are not over-reliant on digital partners for sourcing customers for these products. And with our partners, we want to make sure that our commercial arrangements are such that there is a balance in those commercial arrangements, and the primacy of the brand and experience remains with the bank. They remain bank's customer as much as our partners' customers. So in credit card, we are hoping that our organic sourcing, when I say organic digital sourcing, will go up to 45% from 30%. And in personal loans, we, of course, we just started engaging with some of these partners where digital DSAs. We, of course, want to continue to grow that. But personal loan, again, we want to create capabilities within our firm to source new personal loan customers. And on savings account, largely our digital sourcing is fintech based as on today. We again want to create from 2%, we want to move to 25% of those customers we want to acquire on our own, and rest we can still work with our partners. So there is some rejig in the strategy here, which we want to implement over the next few years. Theme 9 about people and culture. I think, as I said earlier, I think vertical heads as CEOs of the business owning the profit and loss account, collective focus on profit and loss account is an important change we want to make. I don't want to be the, I and my colleagues on the board, Harsh and Shalini, don't want to be the only people bothered about the, and of course Venkat, don't want to be the only people focused on the P&L. We want to make sure that there is collective focus on the P&L. Of course, agility, astuteness I talked about, making BM role attractive I talked about, enhancing sales culture I again talked about. Generalist versus specialist is an important change we want to make. We have a rotation policy which changes people every 3 years. We want to be slightly more mindful of how we do that for the benefit of the employee as well as for the benefit of the organization. In some roles, we may be okay creating more specialists and staying them in that role for longer, or where it benefits the organization, we'll stay them in that role for longer. Alternate cost, low cost channel I already talked about, and identifying talent gaps. This is again important. Some of the areas we are wanting to build our future on requires new talent intake, and we are clear that in some areas we'll need to be focused on that. Cost optimization is, of course, the best cost optimization is about enhancing productivity. And we will remain, like I said earlier, remain focused on how we can enhance productivity. We are working on scorecards for employees, scorecards for branches, which all are focused on higher productivity and higher outcomes. So therefore, this optimizing cost is, instead of optimizing cost, I would say I would optimize outcomes to draw the bigger line next to the smaller line, kind of strategy on enhancing productivity. Introducing low-cost sales channel we talked about. And third is a very important point. We have a subsidiary called FedServe, where we think we can leverage that even more than we have done till date, where we can move some of the activities at lower cost to FedServe and reduce cost of our operations, whether it is to do with back office, call centers, or operations. So this is an area where we think there is more scope to and an opportunity to optimize our costs for operation. Centralizing and regionalizing processes, I already touched upon it in another context, but this we think will lead to some cost optimizations. AI and automation, again, Venkat will talk more in detail about some of the projects there. And here the last element is, of course, cost rationalization, where with a tooth comb we are going through what are the current costs on what, and can we optimize the existing cost structures on many, many things. And this is a project we have just about started, and we will find areas where we can cut costs. Though that is not, I think the bigger benefits will happen on the top than at the bottom, but yes, it is still an area which is important. I also think that given the fact that there are new initiatives, branch network, wealth, newer profiles of people that we have to recruit, talent that we have to recruit, I do think that while cost optimization is important, I think we will go through a phase of investment which will mean that the downtrend on costs may not be visible very early, but I think it is important to invest in that future and remain focused on the outcomes rather than controlling costs in some. Having said that, we do believe that some downtrending of the OPEX can be achieved over the next 3 years. Any growth, you have to earn the right to grow, and the only way you earn the right to grow is making sure that your conscience functions stay absolutely strong. They have their voice in the organization, they have their ability to speak up and put their foot down when it is required. And these are 3 functions like that: compliance, risk, and audit. And of course, while all these 3 are very, very important as a right to grow, strength of these functions give us the right to grow. The one favorite topic I'll call out on this slide is, of course, the better RAROC-based pricing, which our risk function, along with the risk function, we have to be able to create the right framework for pricing, which is good price management is good risk management as well, because it pays for the cost of risk you take. And of course, there are other projects like automating the compliance function or building in-house capacity in some information system audit kind of thing, which is an emerging area, and therefore we need to build in-house capability. So these are functions which are very critical. In fact, entire automation of the compliance function is another important project that we are driving in compliance. Theme 12 is, of course, the evolution towards a universal bank. And this is today, of course, we have an NBFC and a life insurance associate company as a subsidiary or associate. Over a period of time, either within the bank or outside the bank, either organically or inorganically, we will have to acquire these capabilities over a period of time. And this is a journey, and all of you know that these things, the inorganic part of this can happen. It is an event-based thing, but even organic takes time to build up. So I think, but the important point we are making here is we are clear that we need to make this journey from here. And over a period of time, we will build this, some of these functions into the bank's operations. It's all good about strategy and talking strategy, but as I often say, a suboptimal strategy and superb execution is dramatically superior to a superb strategy and a subpar execution. Yeah? And I am always a believer that the difference that most organizations know what is to be done. Strategy is no big deal. Yeah? Of course, yes, you have to customize it to the organization's DNA, but the real difference happens in execution, and we remain focused on execution. In fact, what we have done is we have created, arising out of this strategy document, we have created 150 projects, 50 of them what we call major projects, 100 of them ancillary projects, and all the projects have an owner in the organization. They have an owner, they have put down a document where they have written what they will achieve at the end of this project. KPIs have been defined, how we will measure the success of these projects. We are in the process of creating a project management office. We will seek external help if it is required, and we are creating a monitoring mechanism which will make sure that the execution remains on course on some of these projects. Of course, these projects can vary from being short-term to projects which take 1-2 years to execute. But the important point is full ownership is defined, KPIs are defined, timescales are defined, PERT charts are defined, and we will make sure that we execute these plans in a manner that really gives us the outcome that is required. And I thought it was important to emphasize the fact that if I have to choose between a good execution and good strategy, I would choose good execution over good strategy. Of course, that doesn't mean you can do a poor strategy, but so execution remains very important. So ROE, of course, we are assuming that we will get to our ROEs led by ROA growth. And ROA, the way I see it is the biggest benefits in ROA will come from cost of funds, then on fee, then yield on advances, and then cost elements. And we think the build up to a better ROA will happen through these over this course of period. Of course, the timing, I just want to repeat this again, what I said earlier. The importance is not of the numbers here, because these numbers can change for the sector, it can change for them, it can change for us. The idea is that the point we are making is the positioning of where our ROA should lie. Our ROA should lie somewhere in between this pack. Yeah, that's the point we are making. The actual numbers could change. But having said that, therefore, we think we can, over the next 3 years, we'll work towards building our ROA and therefore ROE to closer to the best 3 in the competition set. And of course, optimizing capital allocation and improving risk-adjusted return will add on to the ROE part of it, in addition to the ROA growth that we will build. So that's how it is. At the end of it, when we take stock of the entire portfolio of products we have, and we plot them on a map, which is ROE and business size on the two axes. Currently, a lot of our products lie in this quadrant, which is low ROE, low size. They are not to scale, the products have not scaled vis-a-vis the rest of the competition in the market, or their ROEs, because they are subscale also, sometimes their ROEs are lower. So our product portfolio looks something like this today. Of course, we do not want micro loans to go to that side of this chart, right? Because we want it to remain reasonably small. But this chart shows the predominance of our products lying in this sector. And this is what we need to, what we are thinking about is how this will look 3 to 5 years later. I think more of them should move out of this, sorry. Yeah, so basically the point I am making is that more of them will move towards the that quadrant or closer to that quadrant is what basically we want to say here. Yeah, so this is how we want it to look. So yes, there are products here. Credit card will never be large. Credit card will never be large, but it will be a high ROE product. So there are more, some will either move to this quadrant, which are high ROE, may not necessarily be size, and some will move to that, and less will remain here. And this is how I would look at the product portfolio over the next 3 to 5 years growing into. So I would say that is where I would end, and Rashmi can, Ria can take over. Ria can take over. Thank you so much.
Thank you, Manian sir, for sharing your vision and the road ahead of Federal Bank. At this point, we will take a 10 minutes break to allow everyone to refresh. With over 250 participants in the hall, we wanted to make this process as seamless as possible. On the screen in front of you, you will see a QR code. Please scan it and submit your questions. We will address them in our next segment. Additionally, you will also see the contact details of our Investor Relations Head, Mr. Shavik Roy. While most of you already have his coordinates, please, we encourage you to save them. He remains available for all the queries and follow-ups. I request you to be back in 10 minutes. Thank you. Requesting everyone to settle down. We'll start in 2 minutes. Requesting everyone to settle down. We'll start in 2 minutes.
Ladies and gentlemen, can we please settle back in? There are a few more sessions pending, gripping ones, of course. Can we please come back, settle down, paucity of time, let's bear that in mind. And in the meantime, we have 2 QRs, as my host here mentioned. This is for the questions, if you have any questions. We want to keep it very democratized, which is why we have placed this QR over here. Please scan this and enter your questions. As we reconvene, we are going to address all of them. And that QR would give you an access to my contact details. You can directly save it on your phone. Can we please settle down? We'll probably have to ask others who are outside to come back in. We'll do that. Also, there are water dispensers kept here and at the back of the room. So in case if you need water or refreshments, it's available, just in case.
Welcome back, and thank you all for returning on time. During the break, we have received insightful questions from the audience. We appreciate the enthusiasm and engagement. Now, moving forward, our retail banking success is shaped by a leader who understands both operations and customer needs. Please welcome our Executive Director and Head of Retail Banking, Ms. Shalini Warrior. Please have a round of applause.
Good evening, everybody, and thank you very much for coming back with duly fortified, I'm sure, with the coffee and the samosas and the tea cakes that were there, ready for the next bit of what we're going to do. So in this half of the Analyst Day proceedings, what we will do is I'll go through a few items on retail. Harsh will come on and cover wholesale and the other businesses that are there. And Venkat will Venkat will come up with the wrap-up on the rest of the stuff that we needed to cover today. I appreciate Manian and Venkat have clearly articulated a very large part of what we're going to do for the next 3 years. And I'm fairly certain there have been a large number of questions that have come up on the basis of that. Our intent, therefore, is to keep this session a little short. We'll try and complete it as soon as we can. So that gives us an opportunity then to interact on the questions that we've received, because that would probably be the more useful aspect of this whole Analyst Day. Nearly 2 years back, in the same room, we had met together and we had a very detailed presentation to the group of analysts that we had. I thought it would just help to recap a few of the data points since then and our journey that has happened. Deposit growth has been steady. We do know that there have been challenges in the industry. What is notable, and if you had participated in our investor call on 31st December, post the third quarter results, you would know that our retail granular deposits continue to be very good at about 82% of our total deposits. We continue to grow our strategic assets, namely credit cards and business banking, both of which I will cover in some detail in the later parts of my session. Over the course of the last couple of hours, you would have heard Manian and a lot of Manian, Venkat, and Ria, for that matter, speak about the fact that our entire philosophy remains digital at the fore, human at the core. Rishta aap se hai, sirf aap se nahi. And these are not just mantras for us. These are really tenets that we embed into our people and into our processes. As an indication of some of the progress we've made in that, and you will see that on the slide, if you look at the NPS survey results, and this is a survey that NPCI conducts on behalf of all banks, we continue to do well from an overall NPS perspective. What is even more notable is that on particular products, for example, UPI, one of the largest volume of transactions that has processed through UPI, we are ranked 1 out of the 13 banks that are surveyed by NPCI for UPI. I want to spend a minute on the bottom part of what we've covered over here, which is on the CX implementation. We started a journey on an implementation of a CRM solution about 3 years back. The solution, which is an Oracle solution, has 3 components to it: sales, service, and marketing. The service and marketing components are nearly done and well embedded. Sales, we have a few more modules to work on and complete, but the progress that we've achieved over the last couple of years has been notable, and we do believe this will be a trigger to greater success on the sales front in the coming months and years. On marketing in particular, we use a tool called Responses, and I'll give you just a couple of examples of how this has helped us. One of the challenges that has been faced by the card industry, both the debit and the credit card industry, is that customers tend to keep their card controls off, and while they're at a transaction, they forget about the fact that their card controls are off, and this becomes a decline. Through Responses, we now have an API solution that can push a notification to the customer on his mobile banking, and that enables him to literally on the fly switch on his card controls and thereby complete the transaction and come back to switching it off if that is what he desires to do from a security standpoint. This has resulted in incremental spends of nearly 30 crores per month on our debit card and about 3 crores at this point of time on credit cards, which we've just started the journey on. Another example of how Responses has helped us is in our customer base, which is a very large chunk of the bank's customer base, the process by which the customers had to fund their account after it was opened was taking an inordinate amount of time. We did some tweaks using Responses, and we've now got nudges in place which enable the customers to not just know the fact that their funding is required to be done, but also enables them to identify what is the easiest way to fund the account, what are the links available, and how they can fund their account. This has reduced the average time of funding from as high as what used to be 80-odd days to about 11 days, and has also increased the size of the average funding that is done. These are just 2 examples of what has been a remarkable journey using the marketing tools, the ability to do customized nudges and notifications based on the profile of the customer and the usage pattern of the customer. Digital, Manian has covered a very large number of items on digital. I'm not going to repeat that, but a couple of call-outs that I would like to focus on over here. You will see our digital assistant, Fedi, and noting to the effect that nearly 25 lakh queries a year are now answered by Fedi. These were typical queries that used to go to our call center agents, and we had call center agents deployed on these queries. By the use of the chatbot, we've been able to rationalize our call center capacity and reduce it. Our Fed Mobile, which is our mobile banking platform, clocks nearly 21,000 crores of monthly volumes. Our rating in Play Store is now one among the top 4 in the banking industry. And as Manian mentioned, we do believe that there are huge opportunities for improvement in Fed Mobile, primarily from an architecture perspective, as well as from an ease and convenience of usage. That journey of improvement for Fed Mobile has commenced, and in the next couple of years, we will in phases roll out a materially improved mobile banking experience for our customers. Our presence in the market has been increasing, and what you see out here is just a sample of some of the work done. Manian mentioned the fact that we recently completed a diagnostic study on brand salience. The results show that our brand consideration, particularly outside our home state, has gone up in the last 3 years. Having said that, this is a journey, and the more investments we make into things like branches as well as marketing initiatives should help us gain greater brand salience, particularly outside our home market. Over the next few slides, I'll just go through some of the details of branch banking and each of our key retail products. We have kept all these slides quite simple. We have one slide which gives a snapshot of the business and another slide which focuses on the key initiatives. I don't intend going through all the initiatives in details, but will call out a few notable ones. And Manian has covered a large part of that in his presentation too. The biggest strength for us on the branch banking side is actually our customer connect. You will hear this repeated theme across all the presentations. This was quite evident recently when Manian and I had the opportunity to interact with customers in our Middle East markets. And the connections that they have developed with the bank are deep-rooted and are loyalty beyond compare. Our relationships give us the platform on which we can develop greater products and greater services for them. We recognize, however, that we have missed out on certain opportunities relating to the younger generation, and we're also not completely present in some of the high GSDP states. Our focus, therefore, is to expand distribution into the chosen states. We have gone down to a PIN code level to identify where do we think our presence is most required and what do we need to do to improve our presence and get branches in those locations. The other aspect of what is notable is that our capacity that is devoted to sales has been comparatively lower when compared to key competitors. And therefore, addressing some of these will be key initiatives that we will be working on. The single biggest initiative in the branch is what we call Free the Branch. Manian covered this in detail. The visual imagery of this is really about the fact that if you visualize the branch today, where a larger proportion of the work done in the branch is more operational in nature, and a forward-looking view of this would be where a larger part of it is obviously devoted to sales and front-end service. The customer connect that we have developed is something that is a strength for us and is not something we're going to lose in this process. However, converting that service excellence into a strategic advantage and using that to develop greater sales connections is where the philosophy is. The Free the Branch project has many, many dimensions to it. We have already identified a range of mini projects that need to be taken up to deliver on this visualization that we have in mind. And we have deployed resources who are devoted to this activity, and over the next 12 to 18 months, we'll be able to reshape how our branches look. Following through from branches, deposits, and as Manian said, branches will be clearly the key conduit for us to grow our deposit base. The customer relationship is evident from the fact that we have a dominant share of deposits in our home market. How do we translate this into a dominant share in other markets is a key focus for us. We see an opportunity in the mass affluent segment, not just for deposits, but also for allied products like wealth and retail loans. Gaining share in this segment will require delivery of new products, new capabilities, enhancing coverage of the customers through RMs. While we do have about 300 odd RMs serving this segment, we plan to increase the capacity and find alternative ways of reaching out to these customers. A range of initiatives by its very nature in the case of deposits, and you'll see them listed on the slide. I'll call out two of them in the interest of time. The first one is the focus on CA, current accounts. As Manian mentioned, while our SA to deposits ratio is probably in the ballpark of what is close to the best in class, not yet there, but close to best in class, the gap is very notable on the CA side. And therefore, the focus is on expanding our CA offerings. As an example, we are one of the banks that has deployed sound boxes, and as we speak, we have about 50,000 sound boxes that have been deployed across merchant locations in the length and breadth of the country, and the balance in the allied car accounts has gone up to about 1,000 crores. We need to do much more than this, and we need to have customized offerings for the various subsegments that are present in this large conglomerate of car. Harsh will also speak about CA in his deck because the contribution from commercial and corporate banking is also high in this segment. The NR proposition, again, at the cost of repeating ourselves and repeating what Manian said, this remains a moat for us. A significant market share in NR deposits, in particular on NRE deposits, we have a significant market share. Having said that, if you peel the onion a little more, it is evident that this share is primarily driven by the GCC Kerala corridor. How do we go beyond GCC to the rest of other countries where the Indian diaspora is present? How do we go beyond Kerala to the rest of India where we are where we have branches and we are adding branches? That is really the initiative that we are working on. This will require a very different way of opening accounts, a very different way of servicing accounts, and more importantly, having a plethora of products that suit that profile, because the non-GCC diaspora tends to have very different needs from the GCC diaspora. So getting that proposition right and delivering that proposition in an online-offline mode is what is one of the key initiatives we are working on. Manian also referred to mass affluent, and you will see that in the slide. Which is the products that we need to develop for mass affluent, and most of them will be around the wealth management proposition. On wealth and insurance, as Manian mentioned, we've made considerable progress on the insurance side, and our insurance offerings are quite close to best in class. This financial year, we added 2 more life insurance partners, both of whom have started ticking well, and what used to be a single arrangement with AGS Federal as associate company now has 3 companies in the fray from a life insurance perspective. Moving to the wealth side of the business, and that's where our greatest focus is going to be. We will invest in new technology that is designed to help DIY journeys for the mass affluent, while at the same time ensuring that we have a high-touch physical intervention for the more affluent segment. The non-resident population that I spoke about needs a very different kind of wealth management propositions. They need bespoke solutions that cater to their needs because they're very different to the resident population, and those will be delivered by us. So if you take this entire aspect into account between branch banking, deposits, and wealth and insurance, our focus is really on ensuring that we have adequate number of car products in sight for our customers, as well as ensuring we have capabilities that deliver to the mass affluent. If I were to move on to the credit card once, we are relatively late entrants into this entire space of credit cards, and there have been some challenges in sourcing and growing this business. Having said that, our digital journey that we have is a very well-optimized one, and our product offerings are also strong, which is evident from the fact that our spends per card tend to be best in class despite our late entrant into the business. We are seeing great traction in areas like the use of credit cards on UPI. We have also resumed issuance of certain co-branded credit cards with Scapia, for example, and we do believe we are well positioned to be able to scale up this business. Our single biggest initiative right now remains how do we scale up more numbers on credit cards. Several measures have been put into place and are being put into place. We have deployed feet on street to reach out to both existing and new customers. The entire process for the feet on street continues to remain digital. We do not have a physical application form, but the physical touch helps to ensure conversion rates are much better than what they would be normally in a self-service journey. Expanding our pre-approved offers through a multitude of pilots and tests is also underway. We are working on the commercial credit card proposition, which you will hear of shortly when we're ready to go into the market. We do believe that's a very close value proposition to the SME side of the business, which is one of our chosen target segments. We have access to a number of platforms for EMI conversion, which is very important because the industry as a whole is seeing revolver rates coming down. Having said that, we remain cautious on the overall unsecured space. Within the given boundaries of unsecured, credit card is clearly definitely more lucrative and attractive to us than personal loans. On personal loans, we have demonstrated steady growth in the personal loan space, not very aggressive given the current market environment. We focus on cross-sell to existing customers akin to what we've been doing on credit cards. While remaining cautious of the market, we do want to expand our offerings, and one of Manian's slides referred to the fact that we will use a combination of organic and partnership. Today, it's at about 38% is partnership process, so that the cost of acquisition and cost of origination comes down. Home loans, this is a product which really is something that, again, we've done well for a long time. Having said that, the market is so competitive that pricing becomes probably the only lever that all banks work on. Our focus has therefore been on seeing what can we do to improve customer profitability here. And cross-selling savings bank account is probably the best thing that we can do in this segment. As we speak, nearly 85% of our home loan customers who are onboarded, for example, in the month of Jan, have actually opened savings accounts with us. And this has been achieved through a plethora of interventions at the sales level, as well as good product propositions for the customer. Our analytics show very clearly that a home loan customer who has a savings account tends to keep higher balance in the savings account as the EMI gets serviced through that. One of the initiatives we are working on, and this links back to the Free the Branch initiative that we have covered earlier, is a large part of our activities on home loans are still done at the branches. How do we free the branches from some of the operational activities relating to the home loans, and therefore regionalizing some of these activities into retail loan service centers, which is along that continuum of elimination, centralization, regionalization, will help us. We've started this off in a couple of centers and are beginning to see the results of that, because it helps us the ability to not just free the branch from the activity, but also standardize some of the processes and ensure errors are minimized. Business banking. In Manian's presentation, you would have heard many references to the SME segment. The business banking segment speaks to that the business banking business speaks to that segment of the customers. The yields in the segment continue to be attractive. They're collateralized in our case, and also there are PSL benefits that come from it. Having said that, there are clearly some more initiatives we need to work on in the business banking space. Forex and trade. One of the areas where we do believe we have adequate opportunities to penetrate. Originating customers with Forex needs, originating customers with trade needs has been a focus, and we've got now a feet on street who are whose entire proposition is around approaching customers with Forex and trade needs and originating them onto our books. Another key offering we are looking at, something we haven't done so far and we are working on towards, are business installment loans. Our SME book is collateralized. Nearly 90% of it is collateralized. We don't do much of unsecured business. We don't do any unsecured business loans. As we believe we've built up the capabilities now on the unsecured collection side as well as on the unsecured credit underwriting side, we do believe this is an opportunity to make an inroad into the business installment loan market. This is not to say that we would be rampant about it and do kind of rampant sourcing of it, but we have a customer base who we can curate very well and give them pre-approved offers for business installment loans. Current account balances obviously is a key aspect of our business banking proposition, and that's something that is adding to our entire journey towards becoming higher from a CAR to deposit ratio. Getting into a stage where we have differentiated value propositions for the textile owners of Tirupur, to the sugarcane farmers of Kolhapur is something that we've done some work on, and we're going to expand that. So that's really the entire synopsis of what we are. A large part of what Manian covered in terms of the themes, the 12 themes, resonate across every aspect of retail banking. And as they say, retail is really about detail. How do we therefore make sure that each of these initiatives that have been listed down are tracked through to completion and executed well, will form a very integral part of our strategy. As we say, a strategy well written is great, but a strategy well executed is even better. Thank you.
Thank you, Shalini ma'am, for your perspective on retail banking and customer engagement. Wholesale banking requires a leader with a deep understanding of macroeconomics and corporate relationships. Please welcome our Executive Director and Head of Wholesale Banking, Mr. Harsh Duggar.
Thanks, Riya. Good evening and a very warm welcome. Let me start straight away into the parts which I would like to cover. I would like to cover broadly 8 businesses, some boring and predictable, some not so boring, and some exciting, which keeps us not just excited, but also on our toes. So we'll just run through of what we did since the last time we had met up on the Analyst Day, in terms of the growth which has been seen in some of the businesses. Treasury is not a part of it over here. This basically covers the asset verticals, except government business, which is the liability side. What I would like to highlight over here, this is what we're covering over here, but internally we are tracking quite a few parameters in terms of fee to asset, self-funding, yield uptake, and how we manage costs. But what we are covering over here is what we managed in terms of size and growth. A few points over here. Corporate banking, what we had guided last time was in the wholesale side, between corporate and commercial, the shift will be more towards commercial banking. What I would also like to highlight in corporate banking, where the growth looks like 11% CAGR, what has been consciously done is the jaw has been opened wider. The growth has been 20% or 18 to 20%, and we have been consciously filtering out or weeding out clients where we did not get reciprocity or were not really profitable. As a result of which, while the growth is at 11%, the profitability has improved. The government business, which started about 2.5, 3 years back, is something where we have got empanelment and agency businesses, has grown, albeit a smaller base. Gold remains steady and obviously helped apart by the increase in the gold prices, but we have been, and we are the leaders in the private sector banks in the gold business. Inclusive finance, which covers largely micro and self-help groups and JLGs, has grown, obviously on a smaller base at about 4,000 crores plus. Agri and commercial vehicle again, about at 49-50% over a smaller base. Now I'll start off vertical-wise. On corporate banking, 2-3 things which I would like to call out over here. In the last couple of years, we have spread the net reasonably wide. So our presence in the corporate banking space is reasonably felt pan-India, is far, far higher. So the mid-market focus and the deeper geography will remain. Capital market business is something which we have been doing, but this time the focus will be deeper, whether it's debt market client, clients, equity or commodities, and being settlement bankers over there. One part which we started sometime in this year, and we did the deal in the last quarter, was approaching a source and a sell-down model, syndicating deals. So we have started doing that part, which will enable us to write larger value checks, have a stronger relationship with larger corporates, and obviously will be a more efficient capital utilization. The fifth piece is the MNC part, and the correspondent banking is what we would like to focus on substantially. This is a vertical which we had consciously not focused on. With a AAA rating now under us, it's something focused on. With a AAA rating now under us, It's something because most of the multinational typically would prefer to deal with banks with a full comprehensive suite of products and who are typically rated AAA internally over here. So this is one vertical which we'll be focusing on in the next 2 to 3 years. In corporate banking, one more thing which we're going to focus on is in terms of structured products, because when the pricing gets thinner, what we realize that the structured products gives you a yield uptick of between 40 to 75 basis points higher than the plain vanilla term loans and the working capital loans. So that area is continue to remain over here. On commercial banking, our portfolio is extremely granular. A large part has been where we have been sole bankers, extensive geographical presence, and the asset quality over the last few years has been consistently improving over here. The focus in commercial banking in particular would be in deeper geography penetration. We are present in about 25 plus locations with RMs being present there, and then a hub and spoke model. We continue to drive this piece into tier 2 and tier 3 towns. The second part over here, which we have to focus substantially more, is a new LOS, which will cut down the turnaround times for credit delivery. We realize that relationships and pricing both tend to be better if your turnaround times are faster. So that's an area which we're working on with the new LOS. Self-funding, both in corporate banking and in commercial banking, is an area which has been of consistent focus. Even more will be the current account piece within the self-funding piece. So what we are doing now is focusing highly on the transaction banking products, which again takes us back to the trade, treasury, transaction banking, and cross-sell. So this is something which will be the mantra over here. Deeper distribution has to come along with the support service centers also, because we realized in many places, especially in deeper geography, if you do not have a local support or a local advisory team which sits out of there to process the trade and transaction banking transactions, it makes a big difference. Today, we are in about 20 odd locations for just our corporate and commercial banking clients. We're looking to expand this as we increase our RM footprint as well. Another thing which commercial banking will lean a lot is in terms of supply chain products and a lot of cross-sell between different verticals of the bank. So the OEM anchors of corporate banking are the ones which will be used by commercial banking and even business banking clients in terms of dealer and vendor financing. And that's an area which we are focusing as well on. On treasury, a few highlights. We have an extremely significantly high presence with the exchange houses, which people are well aware of. Incidentally, we are also the market leaders in exchange traded volumes. CSGL and arbitrage products, another area where we have a reasonably large share as well and a large presence. The focus over here, apart from increasing proprietary trading, increasing the kind of products which we offer to our customers, and this is true specifically for different kind of hedging products for our corporate and commercial banking clients, would be there. The areas which we are focusing on treasury in particular, is to expand the GIFT City capabilities. We have a GIFT City presence, and we are looking to tap both customers overseas, corporate clients, as well as the move of Indian corporates across the border. Resource mobilization in terms of refinance, in terms of infra bonds, in terms of IBPCs and other things would be looked at in terms of beefing up how we can generate or mobilize resources at a lower cost. Sharni would have spoken about retail trade and FX for the business banking and the retail clients. This is a clear team which will be focusing on this part of the vertical in terms of feet on street, in terms of products, and in terms of digital offerings. NSLR on this side, both in terms of origination as well as distribution, is something which we'll be focusing as well on. Correspondent banking is something which Manian had already covered on, and along with corporate banking, MNC and correspondent banking will be focused by the treasury team as well. Government institution business is something which, like I mentioned, started about 3 years back. We had got the approval from the CBDT and CBEC for collection of taxes. So we are there on products. In the last 1 year, we have got empanelment with many of the states across the country for state agency businesses like Chhattisgarh, Punjab, Haryana, Telangana, Goa is where the places we have got. This is something which we're going to expand further in the current year. Apart from agency business, there are a lot of non-agency businesses which we'll be focusing on. it'll be a very strong contributor for liability, including CASA over here. The focus will be, while the government business, the central government level is very overbanked, but the focus will be on the local authorities, the municipalities, the autonomous bodies is the area where and this will be done by expanding feet on street and taking help of the branch network as well. Some of the products I'm not going to cover over here, but there are quite a few products which we are going to roll out. And digital integration with some of the government departments is a key piece. This is an interesting one. We are the largest private sector bank in this space. A gold loan which has grown 27% year on year for the past couple of years. High ROE business requires less of capital. And one thing good about it is that the bank has the expertise which helps us in terms of growing this business because it has its own, it's a very operationally intensive business. While it has its advantages, it's also operationally intensive. And I know there are questions around the regulatory overhang over here and the guidelines issued. That's something which we are steering our way out in terms of rolling out products. Some of the things which we are working over here, we are having an innovation cell and we will be announcing a couple of interesting products coming out of not just plain vanilla lending, but a couple of other products linked to payments. Second is the focus on fee over here is going to be higher, some of them to cover our costs because like I mentioned, it's an operationally intensive business. We are also in the process of implementing something called a LOS Gold Loan version 3. This will help us in significantly cutting down the timeline for a customer to avail a gold loan at any of our branches, reduce paperwork, and streamline operations significantly. We plan to expand this both organically through our branches as well as through partnerships, taking help of branding and marketing and going a little hyper-local over there. This is catching a lot of attention, microfinance. This is a large part which covers microfinance, self-help groups, and including funding for government-sponsored schemes. Today, we have 20 plus BC partners spread over 20 plus states and union territory with 900 plus branches. It obviously gives us a presence and branding in semi-urban and rural India. We have about 1.35 million customers. A large part of it, 98% odd, is actually the female and the rural segment. So it's quite inclusive over here. High-yielding portfolio with a high ROE. This is something where we continue to remain in this business. We don't intend growing it as a sizable part of the bank's balance sheet. However, this portion will remain extremely profitable. A few areas which we are working on, while I'll go to the next one. One area, this is one business which has a highest cost to income compared to all other verticals. The focus is how we can digitize and automate, make it paperless, make it faster, make it seamless, which is what we are working on. We are working with RBI Innovation Hub to see how we can improve the SHG credit delivery, which is extremely good in terms of asset quality and still standing out even for our. SHG is one business which is branch sourced for us, has an extremely good asset quality, and even during these difficult times. BC outlets will be expanded. One of the few areas where we have actually guided the BC partners is that this is an area where we will probably effectively try to give and lower the interest rates which is actually borne by the borrowers. The only reason why we will be able to do that part is by increasing our scale. Second is by cutting down costs significantly. Third, what we told our BC partners, you will use the same infrastructure to sweat the assets out, but bring down the cost for us. So that's something which we have negotiated even this year, lower as to what we were paying earlier years. Another area which will be using the BC network is for liability mobilization. One interesting statistics, there are about 42 regional rural banks with about 22,000 branches having a deposit base of close to 6 lakh crores. Which means that there are banks which do not give the best of products. They are not completely digital and yet manage to do that part. So we do see a large part. The only important aspect was how we can bring down the cost per transaction in that segment. So it's going to be a big project, and we're looking to see how we can use the BC network to source this piece. Apart from that, it'll be catering to the entire requirement of a customer, because what we realize that a micro customer typically has one microfinance, and then there's a huge gap. So we're going to fill this up with various products, secured and unsecured as well. So customers who have a very good track record may still get a higher ticket loan on an unsecured basis, and then there will be secured micro lending. Other products which we're looking to get into is affordable housing and micro labs. This will be, compared to what Sharni was mentioning in the housing side of it, those will be typically larger ticket ones within the affordable housing. And what this team will cover through the BC network would be the micro housing loans and the micro lab piece. So what we plan to do is to be a full service banker to the bottom of the layer of the pyramid. This is Agri. 80% of it is PSL with 1 lakh plus customers for us. We have an extremely robust platform. I think we had covered that last time also, that we can deliver or disburse a loan in under 5 minutes for a new to bank customers with various API integrations. So we remain extremely strong over here. Couple of things which we'll do over here is, apart from expanding the product piece, apart from using the Agri stack and other pieces, the important focus over here would be on the collection mechanism and the recovery also, because these has its own challenges and we are very seized of those issues as well. Last of the lot is commercial vehicle. We started this about 5 years back. We have a pan-India presence today, a reasonably robust distribution network. About 70% of our branches activate leads for commercial vehicle loans, plus the plus the RM network, as well as the DSAs. We plan to leverage on that part. Some of the areas which we want to focus on very clearly is the used commercial vehicle and construction equipment segment. Our share at this point of time is reasonably low. We're looking to double that piece up. Gives us a higher risk-adjusted yield as well. Second is how we can increase our product base. We're looking at a couple of products like balance transfer, green lending. Over here, we are integrating this vertical also with various other verticals. So if we are going to fund the dealer of the commercial vehicle OEM, then we will look at conversions from over there. If we are going to fund some of the EPC players, then we will fund their requirements for commercial vehicles. So this is something which we are trying it out. So this will tie in extremely significantly with other verticals of commercial and corporate banking and supply chain dealers to get the desired volumes over here. So these are the business which I wanted to cover. Many of these businesses, like if you look at wholesale in particular, is obviously, like I said, a bit pretty predictable and a boring one at some times. But over there, the idea is to do a deeper penetration in terms of the products and structured products. On the retail side, we have enough and more products. The growth opportunities are there. The important part will be how we can bring down the cost to income or the cost aspect of it in terms of delivering the credit to the customers. But between the retail and the wholesale pieces which I covered just now, we remain extremely excited about it. Thank you.
Thank you, Harsh sir, for your insights into corporate banking and future opportunities. Before we close, I would like to invite back our Chief Financial Officer, Mr. Venkatraman Venkateshwaran, to share insights on the bank's digital and tech initiatives and how they are shaping our future.
Good evening once again. What I'm going to cover in the next 15-20 minutes are some of the important pillars of our medium-term plan and why it is central to the success of the plan. Let's go straight first to the point which Manian mentioned on the theme on cost optimization and COE. You all know FedServe is a 100% operational subsidiary of the bank. And we are currently operating in 4 centers in the country. We started in 2018, but really gathered pace and picked up post-COVID. We have about 1,600 plus employees, and the largest center is in Cochin. And Indore is the latest center which we opened last year, largely catering to contact center for the Hindi-speaking geography of the country. Activities carried out by FedServe falls under 8 broad categories, which are approved by the regulator. And what gets done in FedServe is key to the branch transformation and free the branch initiative, apart from related benefits for some of the other initiatives. As we speak, there is a review of the medium-term location strategy for FedServe as well. We do want to make sure that the next center which we open caters to multiple language skills and also has an ability to scale up rather than just say 100 or 200 seater center. We do want to look at a slightly medium to long-term strategy. As Manian mentioned in his speech, the Free the Branch initiative, like I said earlier, is largely dependent on how we centralize some of the operations and move the non-sales activities out of branches. Before coming to that, I'll just touch briefly about what are the activities which are currently being done in FedServe. All the activities listed on this page are currently being carried out at FedServe. But what we do want to do is build on this, deepen it, and create the scale. For example, let's take account services, accounts and KYC services. For say SA individual account opening, whilst we do have a straight-through process, what we want to get right is try and get most of it through that, get the first time right percentage higher than where we are currently. There's still a long way for us to improve that, and completely paperless. So that is just one example. LCRD operations started with the SURFACE notice serving, which was done over there. And then we started adding other activities. Collection follow-up was the next. What is important to note is that these are activities which are being done under the direct supervision of the bank. So there are bank officials who head each of these units to make sure that the procedures and process laid down and the approving authority and the supervisory authority is with the bank. World over, large companies are flocking to India to set up GCCs. And there is no reason why we can't scale up FedServe, which we had said earlier is one of our strategic cost lever. And I'm sure it will play out in the years to come. How do we create scale and set up centers of excellence within FedServe? It can't be just a pool of people sitting there and doing what was being done earlier somewhere. We need to look at eliminate, automate, transform the process, digitize, and run it as centers of excellence. To some extent, I can say that the last one, trade finance, is largely done out of FedServe now. The team is centralized, and it has the largest number of bank staff working on that area because it also involves the SWIFT-related activities where it's only a bank person who can authorize. So based on process, we decide how the structure will be. It's quite a flexible structure. Has to meet all the regulatory requirements. And the point which I'm trying to make is there is enormous scope for us to deepen what we are doing in the existing activities, in addition to, when I come to the next slide, cover about what we want to move as well. So this was one slide where both Shalini and Manian talked about free the branch. You can see a host of activities which we believe can be centralized, moved to FedServe. And the activities which are listed here are highly branch intensive, whether it's gold loan related or customer support or customer queries being resolved through phone. We want to redirect all of this to a central team. Now, location is something which we will decide. It could be in more than one location to ensure that we have BCP and risk mitigation plans in place. But as I said earlier, the skill set which we will have here will be of the highest quality to ensure that the best of customer experience is delivered from this team. We always have the tendency to call this as back office. I always say it's not back office for two main reasons. One is the activities done by these teams actually impact the customer directly. And two, activities done in this place, actually they have a direct, like say contact center. It's the operations team which talks to the customer. It's not back office. So it's an operational support team. In my view, very critical, important to have the right skill set and who know the products in and out. We cannot have just human bodies, just interacting with customers. So right skilling, making sure that they are aware of the product, making sure that they know there is a new product rollout happening, and this is where technology comes into play. They will have to be equipped, whether it's a contact center or any other, or ATM monitoring. They should know that there's a new product coming, or is available. How do they get alerts on next best offer so that when they talk to the customer, they can convey that. The virtual relationship manager aspect, again, is beyond just free the branch. In Manian's, Manian mentioned about wealth management. And as we scale up wealth management and other advisory services, the need for relationship managers will expand. There'll be a need for good quality RMs. And not all of them can be geographically spread. There will be certain activities which are virtual RM. Today there are banks who offer that. You can have a video chat with the RM wherever they are based. How do we create those capabilities at a central location? Again, knowledge of the product, knowledge of the process, and knowledge of the customer, because giving the right advice to the right risk appetite of customer is also important. So it calls for skill set which we are working in terms of making sure that the people whom we get into these areas have the right skill set. Next one is on the tech part. This is the second important pillar of the bank's medium-term strategy. And we all know technology is now playing such an important role in most of the activities across industries, and banking is no exception. In fact, in banking, after people, it's technology which is most important. Raj can correct me. In the bank, after sales headcount approval, the largest number of approvals are for tech resources. Raj, you can correct me if I'm wrong. The requirements are huge. Our ambitions have already been spelled out, what we want to. We want to make sure that the resources are in place to support that growth and ambition. We cannot be doing catch-up, and being reactive all the time. So even very recently, there was a large approval which we had for hiring resources. 2-3 elements to this. One is the tech insourcing and capability enhancement part. Traditionally, the bank has been working with a lot of partners and vendors for development and support. A rough ratio would be like 70% by vendors and partners and 30% in-house. It has its own pros and cons, but we believe that the ratio is currently skewed more towards dependence on third-party vendors. It's always good to have that balance in the lever. So we are trying to get, the immediate target is to bring it to around 50-50. The second angle to this is we are able to attract very good talent at the entry level and say a couple of years experience. Extremely good pipeline response to our requirement. How do we make sure we give them some very enriching and good experience for them to develop themselves as well? If it is 70% done by, say, a third-party vendor, the team saw the young engineers end up just being a coordinator, project managing between the vendor and the bank's team. We want to change that as well. We need to make sure that these resources enjoy what they are doing. We use their skill set and give them the opportunity to develop themselves as good professionals in their space. So this 50% is the initial target. We'll see how it goes. I know it's not easy, but it's a journey we have to undertake to make sure that the professionals whom we get into IT enjoy working with us and in developing products. We have to give them the space to experiment, and the innovation aspect will come into play as we give them the room to try out different things. Some of them will fail, we all know that. But then we have to make sure that that environment is created for them to be trying out new ideas and making sure eventually the customer experience gets better. The point on release management is one point which I want to talk about under greater control and flexibility. Today, if you look at our mobile banking, like I said earlier, we have a fairly decent mobile banking offering, but our releases are quite limited in a year as compared to what we would like it to be. There are, nimble organizations in this space who have releases every 2 weeks, 3 weeks. I'm being very conservative by saying 2 to 3 weeks, some of them even faster. Whereas ours is a few months. How do we get better at that? So that is the other objective we want to do by moving into more, bringing it in-house, having better control, reducing dependence on third-party vendors. Obviously builds institutional knowledge and expertise. Yes, there will be the risk of some attrition, which is bound to be there. We can't escape from that, but in the medium to long term, it will pay off. Having the skill set in-house will help us have better control over the quality of output. And of course, enhanced security. On the bottom part, we have a few points like data consolidation via data lake. Today in the bank, the single source of truth for all numbers is from our planning team. And all of us make sure that whatever we discuss, debate, is based on the numbers from that team. We want to build further on this, and both structured data, unstructured data, financial, non-financial, everything is consolidated. And we are embarking on a journey to create a data lake in discussion with a few partners as well to help us in this journey. And the analytics team is also getting beefed up to meet this requirement. On the AI and data-driven business, in addition to the reporting aspect, there are a few support functions related, which we believe is possible through this. And we have already embarked on a few projects on HR. Learning and development is where we are using the AI-driven tools. Fraud detection. Fraud detection is an area which is like, the more you do, the more you need to be kind of investing in that space. There is so much to be done. And the speed at which we respond to this is only increasing. Now there is a need to have, scanning of UPI transactions. It has to be done in milliseconds. You need to have the technical capability to scan fraud detection for UPI transactions as well. And the last one, example which was there in Manian's earlier slide, is on IS audit. Today, we depend on either Big Four or some large firms to do the IS audit. How do we balance that by getting in our internal audit team well-qualified IS audit qualified resources who can do most of the work, and then we rely on the external agencies only for a limited aspect. Because we all know if you go to any of the Big Four or any large firm, it's not cheap. It's not just cost optimization. I think we have to understand that our ability to respond to the tech changes is faster when it's in-house vis-a-vis when it's in the hands of somebody else. Yes, there are areas where we will need external expertise, external perspective, and maybe need to deliver faster. We may not have all the skill sets. Having said that, we need to, today it's like entirely dependent, so we need to just move some extent to get that in-house. Shalini spoke about the CX part in her session, so this is just a graphical representation of that on sales, service, and marketing. She did touch upon the responses aspect for the marketing piece. On the sales, there is renewed effort to use the CX tool to its full potential. It's an Oracle platform, right from lead generation. We want to make sure that the tool is fully utilized, its potential used. We are seeing increased usage of it. The potential to use it, we believe, is huge, and I'm sure we will see the benefits of using this tool. It is also a discipline of capturing the entire customer journey and not left to just say a WhatsApp or someone's having it in their mobile phone. It's institutional memory about a customer, and also it's available pan-India. If a customer walks in to a branch, say in Mumbai, to inquire about something, about a product, it's captured in the system so that tomorrow, whether the person calls a contact center or goes into another branch in Mumbai and asks, we'll immediately be able to say, you went into this branch and asked, we will help you. This is the offer we are giving you. It just helps in making those decisions faster and being able to relate to the customer needs as well. In this slide, we're talking about the point which was mentioned earlier. In the breakthrough slide, you saw tech and innovation is at the core of whatever we are doing. Examples were given about reducing the number of LOS. Earlier, you heard a number of 13 loan origination systems which are there in the bank today. How do we unify them? How do we bring them to low single digits? Ideally, we would like to have 1 or 2. It will happen, but how do we get that number reduced and make sure that it's at an optimal level? On the adoption of low-code, no-code platform, we have recently signed up with a Siemens product called Mendix. Again, this is another step to enrich, enable our teams to be trying out, working on making the changes on the go. It's an agile way of doing things so that they can experiment, they can customize, they can do it in modules. You don't have to wait for the full code to be written. So this is something which is going to go live in the end of the March. March it will go live. Cybersecurity and cloud transformation, I mentioned at the beginning about the need to be investing in this continuously. On cloud, again, there are applications which we can put on the cloud. There are some which we cannot due to restrictions on customer data, and with DPDP, it will become, we need to be more mindful of what we put on cloud and what we don't. And there are things like applications which are non-customer related. We already have a lot of applications in cloud. We'll add to that, whether it's HRMS or learning and development. There are initiatives to have digital cloud-enabled solutions on learning and development. On cloud, there is always this debate about multi-tenancy versus single tenancy or on-prem. It is expensive, but there are areas where we have to make sure that we can't put it in a multi-tenancy environment because the key is with the software service provider, which is not acceptable to us. Areas where we can do, we can't do. It's again a balance and we are in constant engagement with various partners, including discussions with the regulator to make sure that we are compliant with what is expected. The spends on IT, I gave an indication at the earlier session as well. They were less than 4% 4 years back, close to 6.8, medium term 7.5. Best in class in the industry in India today is about 8% of OPEX. Globally, it's close to 10%. Because the pace at which tech is changing every day, we read something new. The latest one being yesterday, at least I read about some quantum computing by MS, which is going to be a different state. Yeah. I don't know what it's going to do, but it claimed to be totally new and change the way computing would happen. Last point about leveraging the AI ML for big data analytics. Like I said, we have I would say, a compact analytics team today, but given our growth plans, the need for our teams to have sharp, accurate information on a timely basis to take decisions on the go is very important, and analytics plays a very, very big role in that. It's not just enough to be investing in cutting-edge machines and tools. You need to have the people to analyze and get insights out of it. Otherwise, it will just be data which is there in a tool, may not serve the purpose. So we are investing in building out that team as well. Currently operating from one location, it will become multi-geography and covering multiple products, including cards. As we expand on unsecured, you need fraud analytics people, and building out on that as well is part of the agenda. I just picked two key projects which is underway. One is on mobile app revamp, and the other one is a super app for corporate customers. Yeah, we have a decent mobile banking app. It serves the purpose today, but we need to be having it ready for the future. Fit for purpose now, but in anticipation of the customer's changing needs and also the changing customer profile which we will acquire as we go along. We need to make sure the app is highly customizable, personalizable, so that the user can decide what they want on the home screen, what they don't want to see. It should be in the hands of the user to customize the tabs. So we want to create that. That work is happening. Today we work with, again, this is another case where we work with a third-party vendor for mobile banking. Eventually, we want to bring it in-house so that we can manage it better, have the releases faster as well. And on the corporate super app, the idea is to have a super app where then the customer, all the segments of the corporate commercial can use the same app, and they can decide which one they want to use, whether it's trade or payments or cash management. All the features should be made available in a single app. And finally, all that we have heard in the last 3 hours, if we do everything, what is the envisioned outcome? You saw the ROA and ROE graph earlier in Manian's discussion. If we deliver the ROA, we're quite sure the ROE will follow. And if we deliver this, we are confident that the re-rating and how the price to book would move as we go forward. This is no indication of the future, but these are expected outcomes which we believe if we deliver. Again, the key here is what Manian said, execution. The focus is on execution. And we have to be ruthless, sharp, focused on it, which we are confident of doing it. There's no going back on that. It's a commitment which all the teams here and those who are not present here have made. Whether the economic environment is not so good, will improve in future, all that is external. What we will be focused on, what we can do to make sure that we deliver on what we plan to, or what we are embarking to deliver. So to sum up, we have outlined our medium-term approach, building on an existing strong foundation. We want to improve the quality of the earnings, diversify the income streams to make sure that we build a high-class franchise. I'll now hand over to Manian to wrap up the session. Thank you.
I just want to make some concluding remarks. I am actually very truly excited about this for three primary reasons. One, as an incoming CEO, one of the things that could have hampered me is the negative energies that could have gone in setting things right. I do believe that it's a great foundation that is there in the platform, and it gives me an opportunity to spend positive energies in building the platform from here. So that's one reason that I am truly excited. The second is, of course, as you saw, every area that we touched, every product area, every segment we touched, there are clearly identifiable levers that can drive the next phase of growth for the bank. And as you saw, went through the presentation, every area Shalini or Harsh touched, we have been able to identify future levers of growth on each of those areas. So that again gives me an optimism that we can make a difference to each of those areas. And third, but last but not the least, I think the pride I have felt in our people of being federal is just amazing, and the team quality is fantastic, and I think it gives me a great base for powering the future. I think all three reasons keep me extremely excited, and as I said, good teams is what are required for good execution going forward, and we are fairly confident we'll be able to make a difference to the way we execute going forward. Thank you.
Can we have the QR codes back on the screen? Yes. So the house is still packed, so that shows the interest in the bank. Thank you. It's a Friday evening, but thanks for staying back. We have 19 questions, and we have put back the QR code again. But of course, we would also like to return home early. So yeah, let's keep it precise. So I'll read out the questions. Manin sir is here. He is going to answer all of them. Here's the first one. What is the balance sheet growth expectation over the next 3 years?
Venkat did make a mention of this in his presentation, right? So we are assuming that we will continue to benchmark around 1.5 times the nominal GDP growth rate is the kind of guidance I would give. If the environment is much better and we get better, we'll see. But broadly, that is the range you should assume. Yeah.
Second question, how will the margin move in the next 12 months, assuming a 50 bips additional repo rate cut?
The math is, yeah, of course, there will be short-term pressures on margins as repo rates fall and deposit rates do not. Venkat did again mention that the fall in deposit rates could be slower than the repo rates. And we do expect, therefore, some short-term pressures. But remember one thing, that I just want to repeat that. The arrows and the numbers we put there, as I clarified earlier, those numbers are not important, right? And the entire industry benchmarks could change. When we said best 3 and next 3, the best 3 numbers could be different, next 3 numbers could be different. The idea we were trying to convey was that we will like to fall in the middle of the pack there among the 6. And of course, whole thing may be elevated, whole thing may be moving downwards, but the idea is to see where we will lie ballpark. Exact numbers, we are not giving here exact guidance on where the NIMs will be or where each of those matrices will be. But having said that, this plan is a medium-term plan, and as Venkat mentioned, we remain medium-term positive. Short-term pressures, yes, there will be some short-term pressures, but we will navigate them as they happen.
Sure, sir. Next question. What are the key milestones and priorities for the bank?
So we talked about most of them through the presentations. I'm sure there were enough guidance. There was enough guidance on that.
So we move on. On slide 20, you show an aspiration to improve the CASA ratio from 30% to 36%. Given the limited CASA growth in the industry and most banks showing negative trends, why do you think you can succeed?
So like I said, I did mention this, right? Our key difference is in CA. And we believe that we have not exploited the CA opportunity even within our current network. Even in Kerala, we believe that the CA opportunity is more than we have exploited. So I think just the right focus and right execution is what is going to, 4 out of that 6%, as I mentioned, has to come from CA. And let me just give you a sense of, even over the last 3 months, we have been able to make dramatic difference to new CA sourcing. And the teams have really rallied around to making that happen. So the fact is, we are already seeing signs of CA. And like Harsh mentioned in his presentation, the SME side, commercial banking, BUB side, there is CA potential in each of them. And we believe that there is opportunity even within what we do to enhance that. And I think it's purely, the reason we will succeed is purely better execution.
Next question, sir. In the ROA progression chart, the credit cost increase appears higher than the increase in the yield on advances. Does this make sense in terms of NIM expansion, or is it a graphical misrepresentation?
Yes, yes. So it's not exactly to the scale. The point we were trying to make there was not exactly, those were not exactly to the scale, but the point we were trying to convey there was that our ROA expansion will be driven more by liability side, then by fee side, then by yield on assets, and to some extent that yield of assets will be taken away by the credit cost. Obviously, we will not, we talked about RAROC and we talked about risk-adjusted returns. We will obviously make sure that the increase in yield is not eaten away completely by credit cost. That was more a graphical representation. My apologies if the bar looked slightly larger than it should have looked, yes.
Next question, sir. Growth trajectory near to medium term.
I go by the same guidance, 1.5 times nominal growth rate. Like I said, short-term pressures will be there. It does look like there will be short-term pressures. But again, if we are on a strategy discussion, we should be talking 3 to 5 years, and we remain reasonably confident of, on an average, getting those kind of 1.5 times nominal GDP rates. Yeah.
Sure, sir. Now, approach to taking higher initial costs. How should we think about the near-term reset?
No, like I did mention that yes, there will be some areas where we'll take higher costs, but you also saw focus on taking activities, centralizing them, trying to get cost efficiencies. Of course, we are trying to balance multiple objectives at the same time. There will be some balancing of, we will try to, you did see some cost rationalization measures that we are thinking about. Our effort will be, of course, to find cost rationalizations which we can invest back. But having said that, investing is important. That's why I showed very little gain out of cost in the ROA gain, right? That was, so we will obviously try and keep it somewhere there by trying to get efficiencies to pay for the investments we make. We'll try and balance it as much as possible. Yeah.
Next question, capital planning. What is the bank's strategy?
Just now, if I take into account this year's profits, which we have not yet built into the capital adequacy numbers, if we build in that, we will hover around a 16% capital adequacy, Venkat, 16.5% capital adequacy. So just now, no plans for capital raise.
Sure, sir. Next question. What will be the average loan growth in the medium term?
Same, I think we have answered that question.
Sort of repeat.
Yeah.
When do you see deposit pressure easing for the system?
Anybody's guess, but yeah, you know, it depends on a lot of things. I think the currently with the capital market state, FII flows out, and you know, the current state of liquidity where the system is still running significant deficits, yes, I think the deposit pressures will continue for a while. But you know, I often say that for a bank which is 1.2 3% market share, I think we should worry about wresting market share more than the overall system. I think the bigger banks who have 20% and 10% and 12% market share should worry about the secular growth of the market. I think we should remain focused on wresting market share and growing ourselves rather than worrying about what is happening to the overall deposit growth in the economy.
A big one, sir. Competition has increased sharply in the MSME space, especially after the RBI's restriction on unsecured lending, which was previously driving growth. MSME credit costs remain low, but concerns about irrational pricing are emerging. How do you view this segment from a margin perspective?
Yeah, so I agree with that. I agree with the fact that there is some level of irrational pricing that is happening on focus segments. It happened in home loan. Now this is getting to MSME as well. The only thing I would say about MSME is while yes, loan pricing is getting tighter, the good part is the wallet share in this business can be very good, and if you choose your customers properly, if you have a focused strategy about the kind of customers you choose, you can still make customer level profitability, and there can be strategies beyond just loan pricing which happens in a product like home loan, where any amount of revenue you make from the customer can never make up for a large home loan, underpriced home loan. You can never make up for it. It doesn't happen like that in an MSME kind of a business. So I remain, yes, pricing is getting tighter, but I think it is still possible to play that segment with some, if you play that intelligently, I think it is still ROE accretive segment.
Okay. The problem is the questions are still trickling in. Okay. What if the bank's historic strength in dollar deposits reverses?
No, actually, to get it right, let me, in the NR segment, our largest market share comes out of our NRE deposits, followed by NRO deposits, and then followed by FCNRB. FCNRB, we have often found, is quite irrationally priced, and we have never been a large player in the FCNRB market. While we do have a base, but our market share of the FCNRB, the dollar part of the NRI business, is relatively smaller, and we don't think it is really it is the relatively lower profitable segment of the NR business for us. And it's highly price sensitive. It's and like I said, a lot of irrational pricing happens from very large banks sometimes. We are not that, our strategy is not revolving around the dollar deposits with NRIs. FCNRB is not part of our core strategy.
Okay. Next question, sir. Your branch strategy highlights a focus on metros while also emphasizing mid-tier markets. Given that metros are highly competitive and saturated, while tier 2 and tier 3 cities have high savings and greater wealth generation opportunities, how do you plan to differentiate and capture CASA and wealth management opportunities in metros?
No, so if you saw our strategy, it is a balanced strategy. We do want to focus on tier 2, tier 3. But having said that, the reality of the market is the top 8-10 markets are so overwhelmingly large. In the sense, the 30th branch in Bombay will still be bigger than the first branch in, or the third branch in some tier 2 cities. That's the reality of the deposit market. And therefore, it's also a large market. Yes, competition is higher, but it is also a very large market. So we have to play this game reasonably intelligently. That's why I said in metros, we want to go pin code level, right? At pin code level, so you have to pick and choose your battles carefully in the metro market. It is possible to do, and pick and choose tier 2, tier 3 cities which are fast growing. And there is clearly, it is easily possible to identify those and pick. So we'll play both games in a measured manner. The cost structures in the metro markets are always much higher than, let's say, tier 2, tier 3 markets. So you have to be conscious about multiple parameters when we choose our battles in each of these segments. But I'm reasonably sure we'll be able to apply ourselves intelligently to the challenge.
Moving on to the next question, sir. Exactly 10 years ago, Kotak acquired ING Vysya. Given your M&A experience and the reasonable valuations in the banking space today, does an inorganic growth route make sense for the bank? Reasonable valuations.
There's nothing on the plate just now. In the future, should we be looking at it? Of course, we should be looking at it. Having said that, inorganic doesn't happen. You need some serendipity for it to happen many times. It doesn't happen just because you want something there. It's also important to build your currency well before you get into the inorganic mode, right? So I think there is scope to build our currency in the short term and then look for inorganic. Of course, over 3 to 5 years, should we? Of course, maybe we should.
Okay. The bank is focusing on the mid-market corporate segment. How does the risk-adjusted return in this segment compare to the large corporates? What is your targeted market share over the next 3 years?
So corporate is not a market share game. It is in my mind, it is a very ROE sensitive, wallet share sensitive kind of a play that we must make. We must make a profitable model there in corporate bank. That's very important. It is easy to build market share in corporate, right? You write a large check at a very poor price, you can build market share. So clearly, corporate is not a game to play on market share and price. Because having said that, in the mid-market, the reason we are more bullish about the mid-market part of it is, Harsh did mention it in his session. The reciprocity is much better in the mid-market than at the large market. In the large market space, RBI has the 10% rule, right, for transaction banking. If you are not, it's more difficult to get to 10% of the share in large corporate than it is in the mid-market segment. So in the mid-market segment, it is easier for us to gain 10% of the lending share in that corporate, and therefore demand for much more reciprocity of the more profitable business. So that's the reason it is relatively more easy to make that business profitable and ROE accretive than in the larger corporates. And that's the reason we want to focus on that.
Quite a big one. In the initial slides, you discussed the need for higher upfront investments to gain better profits later. However, the bank has traditionally followed a low initial investment approach, leading to lower fee income. Meanwhile, in the fee enhancement slide, product coordination is highlighted as a strategy. Could you clarify which business/fees would be brought fully within the bank and which will remain under co-origination?
No. By co-origination, I did not mean outside the bank. By co-origination, I meant, example of co-origination, I thought I mentioned it. When we source a savings account in a corporate, it's possible to source a credit card along with that, or an SIP transaction along with sourcing a credit card, or maybe a small insurance along with that. So co-origination is about creating more efficiency in sourcing multiple products, improving product per customer, and therefore making more fees out of some of those transactions. So that is what I meant by co-origination. I didn't mean outside, inside. Having said that, your point about the approach, I did say that we will modulate our approach on where we want to invest more in the beginning for a higher gain later. I did mention that we will change our proportion of digital sourcing in credit cards, which will mean higher costs in the beginning, sourcing costs in the beginning, but it will give us better revenue control of that customer going forward. So there will be, we will do selective, we will select carefully and make sure that some of these products we may take upfront investment for higher benefit in the future.
Something on origination mix again. For NIM expansion, liabilities were mentioned as a key driver. However, reducing the cost of deposits is much harder than improving lending yields through changes in the origination mix. Why not focus more on improving credit origination filters to generate better yielding products and use them as NIM expansion drivers?
No, it is not one or the other, right? We did say that we want to expand NIMs through assets as well. It is not that we don't want to expand NIMs through improved yields on the asset side. And we also said that short-term environment may not be friendly for adding the higher yield products just now. We would wait to get air cleared about the credit costs on those kind of products. Having said that, in the medium term, we have built growth in that, that side of the balance sheet as well. But like I mentioned, the core DNA of the firm is relatively lower risk on the credit side. Credit is the easier part to scale up. Credit risk is the easier part of it to scale up. If we feel confident and the environment gets easy and friendlier, we will remain very alert and astute and agile to make sure that we make use of that opportunity. So it's not that we are saying no increase in yields through assets. We will target both. But like I said, I see an opportunity because our current account is significantly lower than the six peers that we have picked up for these analysis. And therefore, I see bigger opportunity to do that, and that can have a significant impact on our cost of funds. That's the reason our benefit in ROA from cost of fund side is looking higher than the asset side. Yeah.
Next question, sir. The bank is often perceived as risk averse. With the introduction of the new RAROC framework, why not drive NIM expansion through asset side initiatives rather than liability side strategies, given that asset origination is generally easier than liability origination?
We answered. Same question.
So, you know, while I was there, I was getting constant texts that when will Q&A start? Now I know why. Okay. Just give me a second. Right. Next question. In terms of priority, putting cost ahead is easier. Take us through how you're looking at ROA improvement argument, as it is easier to put costs but harder to get productivity out.
Yeah, obviously. I mean, I agree with that statement. Having said that, I think, like I said, we have to be careful about what costs we put, and as in tandem with increased productivity and outcomes that we expect. So we are hoping that we will execute well to make sure that these go in tandem and we actually expand ROAs. Otherwise, of course, it doesn't make sense to put in costs without visibility of productivity out of that.
Along with the tech focus, could you guide on branch...
Sorry, not all productivity increase needs to come by increased cost, right? There are things we are doing here where we are expecting productivity to come without adding additional cost through better focus, better products, better alignment and all that, right? So there are things we are going to do which are going to yield some improvement without necessarily adding costs, which of course we'll prioritize.
Along with the tech focus, could you guide on branch expansion plan as peers' branch count is higher?
Yeah, like I said, we are looking at 400 to 450 branches, which is generally higher than the run rates we have done in the past. I would say just now, sitting where we are, I would wait for productivity gains and the model proof to play out before we get more aggressive with that. I think this is somewhat aggressive, but not very aggressive. Like I said, there is a lot we can do with existing network. Like I said, our existing network, CASA per branch or CA per branch or deposits per branch is lower. We need to push for higher productivity out of that. As we get demonstration of the model working well, we can get more aggressive.
Most of the capabilities you discussed to bring for the future growth and ROA improvement is more expected to deliver from FY27 onwards?
Not necessarily. Hopefully it will start delivering as we go along. Not everything will be with a lag of 2 years. I'm sure we'll start seeing delivery on some of these earlier than that.
While ROA is likely to move up by 25%, okay. By your effort, we have to double up work as analysts to give 50% more in PVB. But can you explain why ROE should go up by 10%?
I'm not getting into what analysts should do and they should do what they should do. All we have to, as a team, make sure is that we expand ROA, and that results in ROE expansion. We are somewhere in the middle of the pack there on the ROE side. We want to get to the right end of that graph, right? And that is our aspiration. The aspiration has to be realized through better execution. That will, of course, we'll remain focused. Analysts and investors do what they do. We will continue to do what we do.
The top 4 private banks all have strong subsidiaries in insurance, capital markets, AMC, and broking. Federal does not have any. Any aspirations to expand these businesses as it would help the deposit franchise as well? You mentioned scaling up capital markets and wealth management multiple times. Will this be organic or inorganic?
So first, of course, my theme 12 was a journey towards universal bank, and we said we will move towards that. So yes, I do recognize that the top 4-5 banks are universal banks, and if we want to be in that peer set over a period of time and aim to get there, we also need to build that model over a period of time. This can get organic or inorganic. Again, that I said in the my chart as well. We will figure our way around whether organic or inorganic happens, but we are clear that is the journey. How will depend on situations, opportunities that happen through the next few years.
In the next 3 years, based on analyst expectation, top 3 banks will see around 15 to 16% ROE. Based on your presentation, you intend to be closer to top 3 banks' ROE, implying 1.4 to 1.5% ROA at 10x leverage. Is that correct interpretation based on graphical representation?
Yes. I will leave the interpretation to you, but having said that, yes, we want to get to somewhere close. See, there are 2 aspects to it. One is the size aspect, one is the ROE aspect. We are not saying we will become size-wise the same as the top 3 banks, but there is no reason for us to say that even at a lower size, we cannot produce similar ROEs as them. So that should be the logic.
Earlier, Federal Bank maintained that they want to be customers' favorite bank and growth was moderate. How has that changed now?
Come again?
Earlier, Federal Bank maintained that they want to be customers' favorite bank and growth was moderate. How has that changed now?
We want to be the customer's favorite bank and investors' favorite bank.
Nice one, sir. Okay. Questions are still pouring in, sir. We'll continue.
Few more you can take. Are there questions coming on Shalini and
I have.
Harsh portion of the? So let them come here and.
As you say, sir. Anything from the regulator regarding investments in subsidiary with similar line of business?
So it's an open issue. Of course, all of you know the draft circular that was issued, and after that, all the banks who were affected have made representations. I would say we are still waiting for the final response on that. I think there is some amount of discussion that is going on at the regulators end. We will know when. Just now, we have no further news after we made our representation on that. So that's where the matter stays just now.
In the initial slides, aspiration was top private bank. Currently, I would name the bank, X Bank, which is the 5th largest bank, is 40% plus on assets and profits. Can it take more than 5 years to reach that milestone, or you can accelerate growth to 2 or 2.5x nominal GDP?
Like I said, I think it's not necessary to be the same size, right? As long as we are treated in the peer set, even in that peer set, the size differences are significant, right? So I think we should not be prisoner of our own imagination on the size part of it. I think it's important to have the right quality of earnings, right matrices, which place you in that qualitatively rather than quantitatively.
What is the status on embargo on co-lending cards? What is the bank doing for the same, and when will the embargo be lifted?
Like Shalini mentioned that in a limited manner with one partner, we have started issuing cards. We have restarted the process. And as other partners fall in line with the requirements for the same, we will progressively restart those other partners as well.
What gives you confidence about stable cost ratios despite investments in talent, branches, and high-cost products?
Like I mentioned this earlier, right? We are assuming that there are certain initiatives which will give us revenue upsides without necessarily increasing our costs. There are definitely initiatives of that kind, which will higher productivity and things like that will also pay for the costs. And we have to calibrate our incurring costs in a manner that we keep those ratios intact or around the same ballpark. Yeah.
Next question, 2 parts on NIM. Federal Bank is a leader in NRI deposits and yet has the highest interest rates. Can the bank cut rates and maintain its share? Is the problem in lending yields from retail or corporate, or is it a customer segment selection problem where low risk implies low yields?
No, so first, our NRI deposits are not particularly high or anything like that. That's not true. That franchise is not price-led franchise in any case. Like I said, the price-led portion of that franchise, which is FCNRB, we do not play that game too much. So it's not a price-led franchise on the NR side. On your pricing side, we did have a lot of discourse today around how we want to be more scientific about pricing, how we want to be more look at the customer value rather than just product value in some cases. So yeah, there is work to do, and we do want to make sure that our pricing gets more scientific and it is based on risks. It pays for the risks we take.
Your strategies suggest approx 40% CAR deposit CAGR growth in next 3 years. Which are the 2 big initiatives which can give this outcome from all the strategies discussed?
Yes, sir. There are multiple things there we talked about, right? Higher focus on the SME segment will lead to better CA. Just the sourcing side focus of branches on CA can lead to that. There is capital market linkage we talked about there, which will lead to CA. There are multiple things we talked about there, right, which will lead to improvement in CA outcomes. 40 or not is a separate issue, but definitely growth of CA. Yeah, we are also starting from a low base on CA, as I said, and low share of the market. So we will look for, and products, we talked about separate products. Shalini did mention about the Soundbox product we launched a few months back, where we have focused on that offering. CMS, we talked about cash management services in Harsh's presentation. There are multiple initiatives that can drive CA.
Thoughts on acquisition?
Yeah, thoughts. Yes, we are thinking about them.
Are we late to the party to grow our unsecured lending? We were a bit slow to grow our unsecured book when the industry identified growth. We are trying to grow now when the industry is seeing risk. So are we identifying this trend? We are getting late to the next party,
no,
sir. Too many questions.
No, currently, we are not growing our unsecured book. If you see our unsecured book, it is not growing, and we see the risk in the environment. Having said that, it can't be late, right? It's not that the whole of the market has been exploited and occupied by current players. I think there is still scope for, if we want to grow, there is still opportunity to grow. But as I said, we will push the pedal on the unsecured side after we get some more comfort on the credit environment on that side.
Top 3
and I don't see a problem with being late to the party there.
Top 3 priorities from the 12 themes discussed.
That is like having to choose amongst your babies. But having said that, all the 12 are very important. Having said that, if one thing that we have to get right is the CASA and NIM are the 2 things that we would like to get right. the biggest priority, and third, of course, if I have three you ask, is fee. So if I'm asked three things to really prioritize, CASA, NIM, and fees are the three.
So I think Venkat sir answered this while he was here. What are some non-negotiable KRAs for the top management executives? And if you could talk about the same for the branch heads across geographies.
Let's, no, obviously, the three priorities are the three priorities for top management, of course. So that should be non-negotiable. But more importantly, I think I talked about the three areas which are very important that they don't derail us, which is the conscience functions that I talked about. I think risk management is key. KRA area for the top management. We want to make sure that our compliance, risk and audit, that framework stays strong and gives us the right to grow, as I said. And that will, of course, be key. And that will be true for the entire team. Yeah.
Any thoughts on savings rate cut or introducing focusing sweep product? Sweep.
We do have a sweep product. In fact, we are focusing on the sweep product for our somebody asked car. So we are focusing on sweep product for our car initiative as well. So we do have a sweep product and we will use it appropriately as we go along. But we are not looking at a rate reduction. We can't pay lower than the top banks here and hope to gain market share. So we are not looking at any rate reductions on the savings side at least.
Many private banks actually have off-balance sheet risk to generate fees. What is our approach here?
No, so we have identified, I thought in Harsh's presentation it was there as one of the bullet points which he probably didn't talk about, but it was there. Yeah, our ratio of non-fund based to fund based is relatively lower. We can do with a bit more of risk appetite there and do something more. We have to choose our products well there. We don't want to issue 10-year bank guarantees to earn that income, but we will be selective, but we will step this up. It is part of the plan. In fact, this is what I was telling when in my closing remarks. Every area we have gone into, I think there are opportunities to build. And that's what gives me the excitement that there is, all this build-up of fee, NIM, all this is not, there is no one silver bullet which solves it. It is a combination of hundreds of small things that you do which builds. And like I said, I'm really excited because we've been able to go into those and identify each of those areas, and we will make sure that execution builds it in a granular way up from where it is today.
Which one segment will be key to drive the next leg of growth? Any challenges to scale any particular segment for Federal?
No, the segments we mentioned are very clear. The SME, the four segments that we talked about, those are clearly the priority areas. Challenge, yes, pricing is always a challenge with some products. Home loan is a challenging product to grow. Just now, home loan seems the most challenging product to grow in volumes. But yeah, from time to time, of course, different products will have challenges. But just now, I think, given the share of market we have, I think if we execute well, I do see potential to grow in most areas.
How do you see credit costs in FY26, especially given the environment and the fact that we have 2x/3x PLCC growth in the last 2 years?
So let's keep guidance on that to a separate discussion. Today, we'll stick to 3-5-year strategy so that we don't get derailed into next quarter numbers and things like that. Yeah.
Your views on the future of FedFina?
So like I said, the regulatory stance is not yet clear. Regulator is yet to come back. Let's see how it evolves. We have to wait and watch.
In ROA delta, which one would take relatively longer to achieve? Cost of deposits, yield or fee?
Fee is the tougher one to get, I think.
With that,
yeah,
we wrap up. Thank you. Thank you so much.
Thank you. Thank you so much. Thank you. Thank you.
I'll ask my colleague Ria to come back on stage for the last remarks. Thank you so much, everyone. Oh, the QR is gone. I hope you have my contact coordinates. Thank you so much.
As we conclude today's session, I want to take a moment to thank each one of you, our analysts, our investors, and stakeholders, for being part of this session. A special thank you to our esteemed speakers. I would also like to acknowledge the investor relation team led by Mr. Shavik Roy for ensuring seamless communication and engagement. As a great Warren Buffett once said, the stock market is designed to transfer money from the active to the patient. At Federal Bank, we believe in building for the long term, making strategic moves with conviction, and staying ahead of the curve without losing sight of what truly matters. On behalf of Federal Bank, I once again thank you all for being with us today. Before we close, I would like to invite you all to join us for dinner, and let's make use of the opportunity. Thank you. Thank you, everyone.